Greetings, traders. It is I, Abdul Shabazz. This is some real change stock options trading journey. And today, this fabulous Wednesday, wonderful Wednesday, March the 17th. So grateful for you guys to be in the building. Let us talk about some money. Oh man, kick ain't on. See if YouTube is on. My kick is not on. See if YouTube is on.
I'm trying to. Looks like it's on. You don't see any chat?
No, nobody in the chat yet.
Yeah, they are.
People are in the chat?
Yeah,
I can't see it.
4 people.
Oh man, let me go to something else. I saw the stream is up,
Yeah.
but I can't see anything though.
You want to see the chat?
I'm gonna try to pull it up on this other chart here.
Oh, did you see?
Hold on, I need to pull it up here. Oh, I just seen the line. Oh, I got 4 thumbs up. All right, thank you guys for that. How do I get to the chat though? How do I pull up the chat? Do you know?
No, I don't know on the tablet.
Bring my
Phone?
yeah, bring my phone.
Oh.
Pull it up from here. Give me 1 second, team. My streaming platform has a little glitch in it. I'm on YouTube, but I'm not on Kick. I'm fine with that, but I can't see you guys in the chat, so I have to pull it up on my phone. 1 second. I have 47 is live right now, guys.
Oh,
I emphasize again, it is
It says his final warning. All right, now I can see Todd Macon is in the building.
live right now, guys.
Big Ben is in the building. Quiet Soul is in the building. Dr. J is in the building. Jesse Swanson is in the building. Big shout out to the team. Thank you all for being here. So I got to pull it up on something else. About to go right back to these plans, team. Show you where we at. So grateful that our teammate reminded us about FOMC. Okay, I'm gonna share with you guys what my mentor just put out to me. He says typically the market FOMC reaction Wednesday and marketplace exceptions will be Thursday and Friday. So just what we talked about, that the market, as I mentioned yesterday, the market could literally go sideways, even though it did have a very nice move pre-market. If there is continuation, then some information has been leaked. So as far as that is concerned. So let's get ready for today. We're still in that control selling algo, looking to make a move back up here to the top of it. Let me get cleaned up a little bit. Let me clean these charts up. Okay, this is our daily top right corner. This is our weekly next to me in the bottom right corner. So far we do have a small green for the week. Bottom middle is a 30-minute chart. That's the look we're going to go for right there on that 30-minute chart. Bottom left corner, 15-minute chart. I'm going to show yesterday's action as well. Pre-market, we have shot up, gapped up a little bit. Gapped up quite a bit from yesterday's close, actually. Yesterday we closed at 669. Well above that pre-market, up to 671. Current 5-minute chart, let's pull that up. Give me 2 seconds here. There has been a nice big move from 8 o'clock. From the 667 to where we are currently. Straight up. Market is going straight up. Big money and the market moves have already started taking a position. Maybe an indication some type of information has leaked. Let me identify the controlled buying algo that we're currently in right now. And there it is. There's that controlled buying algo we're currently in. Now let's pull this up and see how my plans line up with this action. Okay. Where's that line coming from? Let me see something real quick. Okay. Okay. Now let's get busy. Let me pull up my plans. Already put them together here on the trading view chart. And this is what they look like. Looking for a continuation. Again, I told you, for me, that special area for me to get involved is going to be 672.4. I repeat, 672.4. That is going to be the area that I'm looking and interested only in, that area of taking a call, as I explained to you yesterday, as that will then put pressure on Friday's bears as well to start covering. When these bears have to start covering, they have to buy. We have broken out of that controlled selling algo, as I showed you guys yesterday, showing that potential controlled buying coming out of that selling. And so far it's been pretty good. But I was looking for a potential lower high to short at the 671 area. She did touch it and drop down. She dropped down twice. But this morning, she had jumped up from 691 all the way to 670, from 669 all the way to 671. And she even had a low pre-market of 666. So consider that she had a low, even lower than that, of 665 actually, pre-market 665 area, to go from 665 to 672. That's some leaked information somewhere. But again, this is the area that I'm looking for, the 672.4, looking to take that into a call position. Very interested in how the market reacts when the bell opens. Alrighty, so that's what it looks like on the trading view chart. A call above 672, a put below 666. Maybe that might have to be adjusted, I don't know, but if it does, it'll be off a reversal. So I don't know. Maybe I might have to look at 669. I wonder what you guys think. Such a strong move up. Such a huge range pre-market. Huge range. A move like that, it almost seems as if some information has been let out. Again, you can see the market low of 665.2. From 665.2 all the way to 672. It's a huge jump. Like $7. The market has moved pre-market. 665, 2, 5. The market has moved almost $7 pre-market. It's a big move. It's a big move. We're into this control buying algo that you guys see on the screen. Showing, pulling my plans back up. Again, I'm liking that 672.4. This area right here where the market is right now, currently trading at 672.2. I do like that 672.4 area. Looking to see if the market, what it's going to do here, but it's moving very, very strong. She's moving very, very strong. 9 minutes before we get started. So I want to put an alarm here, but it's going to go off immediately. I'll put it at 672.5. Again, this is my area of interest. For a put, I said 666, and I still do like it. Anything above that, the bulls could use as liquidity to take the market higher. So there's no safe puts until we get below the 666. There's no safe puts till we get below the 666. There might be a scalp opportunity, as the market will yield scalp opportunities, but you really have to be quick on the trigger with that. And yesterday was just pure chop, chop, chop. And you can see as the market closed yesterday, okay, at 669, she started coming down post-market. Post-market, she started coming down. And early pre-market, she took a nosedive down to the 665. But after that, somebody heard something, and they started buying the market back up very aggressively. But I'm still at my 672.5 area. I want to see a break and retest, and then I will join that call. For a put, I don't know. If we go back and look at the 669.3 area yesterday, this area of support, once the market broke underneath it, it didn't stay. It bounced right back. She bounced underneath it, then came right back. So I don't feel strongly about a put at this area of support. I have to go to another level lower. But we shall see. Right now, it's looking like it's going to be a very bullish day heading into FOMC. Somebody knows something. Somebody knows something. Yes, they do. Somebody knows something. Getting these charts together, getting them ready. All right, those are my plans. To see if we hold over this level of support at the 672.3. If we do, we already hit a high at 672.5. And then we came back down. If we break that, break and retest, I will be in a call. And if I do get in a call at that 672 level, 672.4 area, I'm looking for 675 to first profit target. Let me go ahead and put an alarm there. 672.5. First profit target is 675.2, which is right here. Put an alert there. First profit target. Second profit target, 677.3. Put an alarm there. Alrighty, I don't really need this alarm right here to grab my attention for the call. It's already there. The market has my attention. It's just whether or not it presents a clear opportunity to take a trade out of the gate. Giving us a nice shooting star here to start off with, which is a bearish reversal signal. So the market might take a breath, which would be good, and then come back and reattack this situation. Well, I'm going to put my alarm there now anyway. Alrighty, so I'm enjoying this pullback here at my area of interest because this is what I want to see if we truly turn this into an area of support. Will the market hold here? And so far it does appear it is holding as I'm looking over at the 2-minute chart right now. Jared Lewis is in the building. It's a great day to everybody. Thank you, Jared Lewis, for that. BFH got my energy today. Let me get a cuppa in here. We'll be ready. Yes, sir. No cuppa for me. No cuppa for me. Yeah, not yet. Next week, Monday, I will be cuppa in hand. Inshallah, God willing, next week, I will finally have a cuppa in hand. Less than 2 minutes for this party gets started. Thank you guys so much for being here. If you have any plans, please feel free to put them in the chat. Grateful Day team. Good morning, good morning. Alrighty, getting my execution laptop up. See what these prices are when the market opens. A'udhu billahi minash shaitanir rajim. Bismillahir rahmanir rahim. Remember, we do not have to trade, but we do have to follow our rules. Following our rules is what makes us money. Take a look at option prices as we get ready to begin here. Aha. Right out of the gate, we had that shooting star, which I told you guys was a bearish reversal signal. Option prices are decent this morning. I'm in the trade. I'm in the trade. Stop is going to be a break below 672. My stop will be a break below 672, but right now I'm in the trade. Added to my position. Take that. Take that. Take that. Yes, sir. Oh, yeah, I got to get some of this. I got to come on out of some of this right now. Put some of this in my pocket right now. I'm playing no games. Take it, because you know how this market will do. I need some of that right now. Yes, sir. Yes, sir. Yes, sir. Just close one position. Allahu Akbar. Right out the gate. Money right out the gate, team. Money right out the gate. Going according to my plans, I called out this area. Had to get it. Had to get that. They were saying, here, Abdul, take this. I said, gladly. You want me to take this? You sure you want me to take this? Because you know I will. I'm not playing no games now. We come up with them plans. Them plans turn into rules. Yeah. Waiting on this area for a minute and still looking for that 675. Yes, sir. However, we're at the top of the algo. That is also why I took some profit, because we're at the top of the algo. You know what happens at the top of the algo? The bear step back in. Happens every time. So why would I sit there and not put some money in my pocket, especially after we've identified the control buying algo? Now, all this is market orders, markets going off at market open. Let's get it, man. Let's get it. Make it an early day for me so I can go get a little bit of rest. Make it an early day for me so I can go get a little bit of rest. Y'all saw. I'm probably going to maximize this 5-minute candle and then regroup. Don't know what could happen. None of us do. But I knew the area that I wanted to trade. It came to that area. I was patient and waited. See if we would turn that area of resistance to an area of support. We did that. It's me being even more patient right here now. All right, just got out of that second position. Just got out of my second position. I'm completely flat right now. Saw some hesitation. Doggone it. You know I'm a premature exiter. You know I'm a premature exiter, but we at the top of the algo. Let me get a nice pullback to get back involved. Okay? But other than that, take that. Take that. Take that. Ain't no games being played. Not with me. Not today. Yes, sir. Nice big dollar move right out of the gate. Amazing. Grateful. Didn't get the profit target that I wanted, but I took the money that the market presented it to me. Best believe that. Those 670 strikes paid very nicely. Right now trading at 413. What a move. What a move. And it looks like I did the right thing too. Thank you, team. I appreciate you guys. But But again, we had been called this move out. Ben showed you what I was looking at. As I always do, I showed you on the diagram that I was waiting for us to get above that 672.4. We broke above it, turned it into support, had the pullback, stood on it, and then she took off. Then you added with that everyone else, let me tell you why and explain why that happened. Everyone else saw that pre-market move of $7 as well. And again, remember, you have people who don't have the ability to trade like we do. So they place orders that get set off right at market open. So once I saw the retest, okay, that turned that to support, and when the retest was this tail down here, guys, the market opened and came down. Then she flipped, because this was a red candle initially. She flipped from red to green. That's when I got in. Once I saw that flip from red to green, I knew this area of support was going to happen. And then you had all of the other orders who were placed at the open. They got triggered. They got filled. Everybody's buy order got filled, and that took us straight on up. Now, being that we already identified this controlled buying algo, we know that typically at the top of algos, the bears step back in. So there was no, being I went so deep in the money with my contract, there was no reason for me to play around once I saw some hesitation. At the top of the algo, pulled the first trigger. Then I waited for the next candle to form. The next candle started off red, then it flipped to green, had a little bit of hesitation, and I got out of my position. Simple, clean, and I hope I explained it well. Again, we're having hesitation at the top of the algo. That's not to say that it won't continue further, but I can't read into the future. I can only see what the market is showing me, and I react. I don't predict, I react. If the market does that, then I'll do this. Now, in order for me to get back in this, the market will have to pull back. I will only get back in a call on a pullback because we still have FOMC tomorrow. It doesn't change anything. As I stated before, the majority of the big money is waiting for tomorrow. Apparently, so we thought, but it looked like somebody found something out already. So, therefore, I'm on the sidelines, and I have no problem with that right now. There's that pullback. Just don't know how I feel about it. Because I don't like buying in the middle of the chart. I bought off this break from red to green, this flip from red to green at a key area of support that I called out. I don't like buying in the middle of the chart unless I see a clear sign here or a clear signal. So I will not be re-entering this trade right now. Additionally, the last thing I'm going to say on this note, the other reason that I got out is because, as I stated, you have a lot of people who place orders to go off at market open. Sometimes the market makers take advantage of that because they see the orders and they counter those orders. So if it's a series of buy orders, they'll put in a big sell order to counter that and put those guys in trouble. I do know that happens as well. So I didn't want to mess around with the market makers. Grateful for the money that they gave me this morning, and I'm content with it. There's another opportunity that yields itself. I will look at it, but now I'm more interested in looking at the quarters. 9:45, 10 o'clock, 10:15. I'm only looking at the quarter marks now, referring to the larger time frame, the 15-minute and the 30-minute. Let's see what they do. Clear that 30-minute up here, and the 15 as well, because yesterday's action is irrelevant right now, as we are clearly above all of yesterday's action. And again, I don't like doing that, team. I don't. Question: if you get back in on the pullback, did you get in at the same trade? No, I didn't get. I didn't get back in. No. I didn't get back in because I understood why she jumped up like that. That she jumped up from just a lot of orders going off at the market open. You can see after that we've had nothing but a hesitation, pullback, another move up to put in a new high at the 673.9, and then we have a hanging man. And another hanging man. But I don't know. No, I would not. If I did, to answer your question, if I did get back in, would I get back in at the same strike price? No, because I was way in the money. So I would not do that. I was too deep in the money because I had a feeling I was going to end up shorting this stock. I mean, not shorting. I had a feeling I was end up cutting it short and not allowing it to get all the way to full profit target. I didn't expect it to come out of the gate and go all the way to 675. You know, I knew there would be some ebb and flows. I just wanted to take advantage of the opportunity when it presented itself, and those 670 contracts shot up like you wouldn't believe. And so with that kind of money sitting me in my face, you know I'm a premature exiter. You know what I'm doing? Ain't gonna look at all that money and did not do nothing about it. So I exited half my position, the first one, and then exited the other half on that second trigger. And I might be done for the day. But nonetheless, I then stated that I don't like taking a position in the middle of the chart. Okay? I don't like taking a position in the middle of the chart. I have nothing to support myself. Again, when I entered the trade, I told you that my stop out would be the break of the 672. So if she did come back down to the 672, I would have gotten out. Up here, you don't have any platform to stand on as of yet. That is what I see. If you see something different, let me know. But it's a big difference. Look, just even here on the first two candles on the 2-minute chart. All right. It's a big difference between these first two big body candles and what has taken place after that. That would have been a nice move there. Again, because you're going off of the 15-minute ORB. Okay. Maybe at the money, but definitely not in the money. There's just too much uncertainty right now. And let me come here to the 5-minute chart. I'm going to blow that up and show you what the volume is doing. Remember that lesson in volume that I gave you guys? When the current candle's volume is larger than the previous candle volume, the market 9 cases out of 10 will continue in that same direction. Look at this volume we had at 9:30. That is what I was taking advantage of. Coincidentally, the volume has started falling off ever since the open. The volume has been falling off. So that would also have me leery about getting back in, because instead of the volume continuing, the volume started falling off. So this also, look at your own charts as well if you can't see it on mine. The volume has been decreasing since the 930 candle. And it shouldn't be doing that if we were going to continue to go up. So that's letting me know strange things are happening. And that's why I was also perfectly comfortable with getting out of my position right there. She's still going up. But I just got to take what, be grateful for what I got. Should I have gotten out of all of it? I don't know. That's hindsight. And I don't double guess myself. It is what it is. I just look for the next trade now. And I just don't see anything to base it off of. This is a very nice break here. Okay, you can see that on the 15-minute chart. Let's pull that up. And that's why I said I'll wait to the next 45. Nice break here. Even if you was hesitant, once we got over the wick at 673.9, that provided a clear potential path before a gap to where, a scalp to where is what I don't know. Even if you got in here at the 673.9, I don't know where you would scalp it to, because my concern is the volume is decreasing. Now this volume candle is looking better. It's looking better. Yeah, it is. It's looking better. And again, that's not to say that there's not a trade there, but I just don't see where I would put my stop at, unless you put your stop at 673.4 underneath the very candle that you got in on. But we're still at the top of the algo. So, we've touched it, but we really clearly haven't broken out of it. Let me show you here on the 5-minute chart. And nothing is exact. Everything is dealing with areas. But even here, when we broke out of the algo, we should have gotten a continuation here. And instead, we got to pull back into the algo. And I still need to adjust the algo now because of market open now. So if I adjust it, then I still feel even stronger about it now. See what I mean? See what I mean, team? If anything, if the market comes back down below 673.4, it might be a nice scalp back down to the 672. If you put these 945 bulls in trouble. A lot of these 945 bulls are trying to catch that wave that initially took place. But again, if you don't understand how volume works, I hope you guys can see the volume bars. See how they have decreased. This one was a good one. The 945 volume was a good one because this were people who thought they were going to get a continuation. So if you missed that 930 and 935 move, they waited for that pullback for 940. 945 came. They tried to replicate the same move. And so far it's not working. Retest of the 5. And that's not to say that it won't continue to go up, but this is a pullback. But I just don't see where you would base your stop at right now. But she still is bullish without a shadow of a doubt. But I don't like the volume. Decrease, red. Nice green one, but a nice another small red. No, you got to stand us on the sideline, guys. Don't mess around and get trapped up and tricked up by that volume. Again, this is my opinion. I'm not a guru. I'm not a whatever they call those guys. I just, I love trading. I love my team, and I just want to keep everybody safe. That's all. And so that's why I pointed that out. And I could be wrong. I've been wrong before, and I will be wrong again. I have no problem being wrong. But I definitely want to analyze what the market is showing us. If we get below 673.5, those late bulls in this 945 candle are in trouble. Put that alarm at 673.4. We get below that 673.4, the 945 bulls are in trouble. This is a nice pullback to the 5-day moving average. But the volume is shot, and I don't like it. Alrighty, guys. Let me go ahead and let somebody else talk for now. But yeah, what I did say this too, I don't like doing that. I don't. Because I like it when we all can get money. I definitely called the trade out. I definitely told you guys that I would be trading if that did take place. But I like it when we all can get money together. So I do apologize for scalping that. But I called it out. I showed the trade. I told you guys when I was getting in. Told you where my stop was. When I got out half of my position on the first exit, I told you that. And I explained why I was getting out then. And when I got out of the second half of my position, I
the SEC
explained that.
reportedly preparing a proposal to change the way the companies report earnings, giving them the option to share results 2 times a year instead of quarterly. Journal goes on to say the regulator might publish this proposal as soon as next month. This has kind of been, David, in the mix for several months now. Ed Bastian actually got asked about it with Phil today and said, might go back to the board and suss out our investor base and see what kind of frequency they're truly craving. Even if it were a minimum requirement, you might end up with companies giving a little bit more transparency than they absolutely have to.
Yeah, I mean, the idea being to sort of, we have fewer companies coming public and being public than we've had in a very, very long time. In part, some of them cite just the need for every quarter to be filing and all the costs associated with. Not clear to me exactly how much of that is true, but it would be an interesting world if, in fact, a lot of companies did opt in to doing that. And by the way, it's optional, we should point out, if it were to even happen. It doesn't mean that you are required to only report twice a year, but you could choose to do so.
Right. The other interesting tidbit out of the SEC is their enforcement chief, Margaret Ryan, abruptly resigning after 6 months. It's a job that most directors of the enforcement division usually keep for years. No real reason given. Was applauded by Paul Atkins on her way out. I think she leaves effective today, but that was another curiosity.
Yeah, enforcement's important there. Obviously, it's typically civil unless it's joined with the Department of Justice. But we haven't seen a lot. I don't know. Do we feel like we've seen a lot of activity on that front, the enforcement front from the SEC?
Well, actually, the bigger story in financials might be the lack of IPO. Not that we have a single IPO pricing this week, and some of the recent ones, like Once Upon a Farm, MiniMed, haven't exactly done well.
No, they haven't lit
post-IPO.
things on fire. That said, if we get SpaceX, if we get OpenAI in 2026 and/or Anthropic, I mean, that will be historic, obviously, in terms of the size of those companies, the likes of which we've never seen going public at that level of market cap.
Right, and the degree to which some of the rules are bent to make things easier.
Well, the index inclusion is key, and
yeah.
we'll be talking a lot more about that as we get closer to a potential SpaceX IPO, for example.
When we come back this morning, Jim has Jensen Huang live from NVIDIA GTC in just a few moments, so don't go anywhere.
Tuesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber. We are live as always from Post 9 of the New York Stock Exchange. We're also moments away from an exclusive interview with NVIDIA CEO Jensen Huang. The company projecting $1 trillion in chip sales by the end of next year. He'll sit down with our Jim Cramer in just a few minutes. Plus, day one of the Fed meeting, we will look at how the Iran war could impact the picture for the economy and rates. And Apollo's Torsten Slok will be here with new data on why recessions are becoming less frequent and what that ultimately means for investors.
First, though, let's get some pending homes data with Diana Olick. Hey, Diana.
Good morning, Carl. Pending home sales in February rose 1.8% month to month, but were down 0.8% from February of last year. That, according to the realtors. Now, this count is based on contract signings, so people out shopping during the month when mortgage rates were falling to multi-year lows. The average on the 30-year fixed even dipping below 6% briefly. That is not the case now, and the realtors did make note of that, saying the improved affordability could make a U-turn if oil prices and interest rates continue to rise. Now, sales were strongest month to month in the Midwest and South. Those are the regions where housing is most affordable. Markets seeing the strongest annual gains: San Diego, Jacksonville, San Jose, Denver, Miami, and Phoenix. Now, just a note, as we head into the all-important spring sales season for housing, apartment rents are softening, and that has landlords now giving more concessions. In fact, the highest level in over a decade as vacancies rise. For more on that, and how trouble in private credit could mean a big boost for commercial real estate, that is all in today's new Property Play newsletter. If you haven't signed up, go to it, cnbc.com/Property Play. Sarah?
Okay, will do. Thank you, Diana. Diana Olick. Guys, it's day one of the Fed meeting, so I thought I would take a look at how expectations have changed in the market for what the Fed's going to do this year as a result of the war in Iran. So Standard Chartered had a really good look at basically, in the orange, you see the expectations before the war, February 27th. In blue is the line as of March 16th, so more recently post-war. And you can see the market was a lot more willing to bet on lower interest rates before the war. They have treated the war and traded the war as an inflation story. Higher oil prices, higher inflation, less room for the Fed to cut. In fact, right now, as you can see, the market doesn't expect a Fed cut until December. That's the only one of the year that the market is expecting right now. Back in February, the market was expecting a few cuts and a much more dovish reaction. The thought was, come June, if Kevin Warsh gets confirmed as Fed chair, he's going to come in dovish and get ready to cut in June. Well, guess what? June now has less than 20% odds of a cut. July has like less than 50%, and then not the first cut priced in till December. Let's see the tone from Fed Chair Powell to see how he balances the risk of inflation.
Now, please tell me somebody got in this scalp. I'll put the alarm there. I told you we get below the 673.4. These 945 bulls are in trouble, and they have to cover. Beautiful scalp right there on the horizon. Rejection off to the top of the algo. I'll put the alarm there for you. There was a second opportunity for you to get some money, and you got 1 minute left, possibly, in this scalp. If you're in it, congratulations. But I had to step away and take a boo-boo. So I missed it myself. I heard the alarm go off, and I said, man, I hope somebody is in that 673.4 quick scalp. And again, that's all it is a quick scalp. Because as we put these 945 bulls under the microscope, we now start running into the 930 bulls. So how much of a support factor will they be? I don't know. But I explained to you, market makers like to trade against the people who can't be present in the market, and they fade those opening orders. So I wouldn't be surprised if you took that nice little scalp there. Beautiful. I wouldn't be surprised if I stated the scalp back down to the 672.5.
here, but I showed you the longer term context because we're nowhere near levels we have been post-COVID, when we saw that big inflation spike in 22, where inflation expectations really got high. That's why the Fed hiked so much, because they don't want to see this. And there's the 10-year, which is another sort of good gauge of whether investors are really expecting inflation to last. And the answer so far is no. We're just not seeing that. And that could give the Fed a little bit more comfort from being too hawkish around inflation, because there is a scenario, and I think the market, is pricing this, and you see this in the futures curve for oil, where when the war ends, oil prices come down, things normalize on an inflation front. That's an if, of course, but that, that's suggested, I think, in the inflation expectations at this point.
Yeah, we'll see. Still watching the forward curve on oil, which says maybe crude goes 75 come December. For more on the broader markets, let's bring in Steve Sosnick, Chief Strategist over at Interactive Brokers, talk about the wild swings here in these past few days. Steve, good to see you.
Great to see you, Carl.
Sarah mentioned the fund manager survey over at B of A. The other interesting tidbit out of that was cash levels, which have gone in the last 3 months from 3.2 to 3.4 to 4.3. That's the biggest jump since the pandemic. Do you think people were truly offsides?
It's hard to say truly offsides. I mean, 3.4 to 4.3 is a big jump. These are still relatively low numbers. I think also what we've seen is there's still a continued interest in buying dips, FOMO, not missing rallies. I mean, we see it, if we get the slightest improvement in oil, as we've done this morning, oil ticked off its highs and boom, up the futures went by 50 points. So there's still this fear of missing out driving people. There's also, I think, a fair amount of almost nihilism. There's this feeling that whatever's going to come of this, it'll all be fine in the end. And so why miss it? And so I think it's understandable why people raised cash into this. The reasons to do so are fairly self-evident in terms of oil prices, et cetera. But there's still this underlying feeling that this is all going to turn out fine. And boy, I don't want to be the guy missing it if it happens.
Some have, B of A is a good example, looking back at 08 and looking at periods in which in that case, the ECB hiked into inflationary pressure, which led to Lehman, as they said, 74 days later. Are you on the lookout for signals of a policy mistake?
Oh, of course. And the policy mistake can also be from inaction as much as it is action. The problem here is the central banks are in a little bit of a bind. As Sarah mentioned, as we saw from the Royal Bank of Australia last night, they raised rates because of inflationary pressures. Right now, we are on a knife's edge here in terms of inflationary pressures coming through energy prices, while at the same time, we have to worry about a slowing economy. Which way does the Fed go if forced to push? And remember, inflationary expectations tend to be very driven off the pump price of gasoline. And so that had been ebbing for some time, those inflation expectations, thanks to the effect of tariffs not being as bad as people had feared. Now you start to wonder if that's going to kick up again. The Fed is in a really difficult situation in terms of both political pressures, in terms of and I hate to say stagflation, it's a dirty word, but that is a valid consideration.
There's also NVIDIA. We're about to hear from Jensen Huang with our Jim Cramer here, and they put out a forecast for $1 trillion by 2027. Concerns about peak data center spending around 26. I think they put that to rest. Do you have to have a view there? Because a lot of what has been rebounding in the market has been the AI trade.
Well, a couple things, Sarah. I mean, first of all, we have to have a view on AI because it's, whether you like it or not, if you're just even an S&P passive investor, you're call it 40% levered to AI, between NVIDIA and all the hyperscalers and then ancillary companies. So call it 40 to 50% of your investment, even if you're just blindly throwing money in an S&P index fund, is related to this. So you better have a view, you better understand it. I do think there's concerns about the fact that not necessarily for NVIDIA, but in terms of other companies where you've had asset light models moving to asset heavy or impingement upon their cash flow, that does disrupt some of the rationale for investing in some of these companies, but they do tend to be predictable earners. And if Jensen Huang, it can meet these forecasts that he's laid out, which he's done a tremendous job of doing, that should ease people's concerns about the AI trade in general, even if they don't necessarily eliminate them completely.
Steve, I want to get your take on various technical levels. People are watching the 200-day around 6,600, the 20-day a little bit north of 6,800. I love the bit that you wrote about Mondays being relatively strong in recent weeks. I guess that's just a relief from coming in on a Monday morning and not having seen everything completely disintegrate over the weekend.
Yeah, I think that's a testament sort of to the general optimism. What I pointed out yesterday was 8 out of 9 Mondays this year have been higher. Yes, the average is about 0.30, call it 35 basis points of a rally. We've had 2 Tuesdays because of holidays; those have been 50. But I do think that looking how we came in Friday, where we just fell out of this malaise and valid concern over what might happen over the weekend. But we didn't quite test the 200-day moving average, but we got it within sniffing distance. And then, when people feel that the worst is behind them, they do tend to rally. Also, we have a quarterly expiration this week, and I know no one really cares about triple witching anymore because of daily expirations. But they do tend to concentrate some volatility, and it's not an unknown feature to see a little bit of a rally ahead of a quarterly expiration. And there's very few outside catalysts where you have the Fed meeting is not expected to be much. So, if you get a slight improvement in the price of oil, you see stocks try to tick higher. And that's what we did this morning. And again, abetted by the desire to not miss a rally and chase one when it appears.
Yeah, you're right about running out of catalysts near term. We'll start looking for more corporate guidance as we wrap up at the end of the quarter. Steve, as always, our thanks. Good to see you. Steve Sosnick.
My pleasure, Carl. Thank you.
Still to come this morning, an exclusive with NVIDIA's Jensen Huang, where he says AI is going when he sits down with Jim Cramer this hour. Plus, how the war is impacting the Fed's rate path, according to some new results out of our Fed survey at CNBC. Squawk on the Street is back in just a minute.
Welcome back to Squawk on the Street. How much are oil prices playing into the Fed's decision on interest rates? Steve Leisman's here. And it says here you're going to tell us, or at least you're going to tell us based on the latest CNBC Fed survey, Steve.
Yes, David, you got that right. Thank you for making that more clear. 3 weeks into the U.S. attack on Iran, respondents to the CNBC Fed survey are forecasting oil prices to remain high for an extended period. Inflation is going to go up and growth will take a modest hit, but the Fed could still cut. I'll walk you through it now. $88 is the average price seen 6 months from now. They're not oil experts, but they have to play one for this survey. And that's going to amount to about a half a point boost to CPI from oil this year, with a 0.3 percentage point hit to GDP. But still, basically in disagreement with where the futures market is, they do see 1.5 to 1.8 rate cuts this year. A slightly elevated increase in the likelihood of recession in the next 12 months, 31%, up 8 points from January, still relatively subdued. Robert Fry, economist, writing in, my forecast is contingent on a resumption of oil shipments through the Strait of Hormuz within the next month. If that doesn't happen, then oil prices go much higher. I will put a recession in my forecast. Looking at the GDP outlook, you can see we did 2.1 last year, kind of the same expectation now. There's the 0.3 decline from the January forecast, but bouncing back right about trend 2.1, 2.2 for 2027. That's the expectation right now. Same idea with inflation. It was 2.4. Now it's seen 2.9, going the wrong way, at least on the headline for the Federal Reserve, which will focus more on the core. And then 2.7, again, not getting down towards that 2% target for the Fed. Key question here, will all of this have an impact on core inflation? 38% say it's very likely, 44% say somewhat likely. Most think it will have some effect, you can see right there. And then there's the Fed funds outlook, which is a little different from the market outlook. You can see it goes down. The average forecast has about a 1.5 to 2 rate cuts built in, a bit more dovish than the futures market. And I think the reason is because many respondents focusing on the negative effects of high oil prices on growth rather than inflation. It goes down to 3.25. Not much cutting after that for what the likelihood of a new Fed chair. For Fed Chair Jay Powell, his last 2 meetings expected to keep rates unchanged, likely because inflation remains above target, and looks set over the next year or next several months to still head higher. Sarah?
Okay, we'll see what the Fed's own forecast show tomorrow in the highly awaited dots. Thank you, Steve. Steve Leisman. After the break, do not miss an exclusive interview with NVIDIA CEO Jensen Huang alongside our own Jim Cramer at the company's GTC conference out west. We'll be back in a few minutes with that.
Welcome back. NVIDIA shares slightly lower today as the chip giant kicks off day 2 of its GTC conference in San Jose. Joining us this morning in a CNBC exclusive is NVIDIA's founder and CEO, Jensen Huang, with our Jim Cramer. Hey, Jim.
Well, thank you, Carl. Jensen, I just want to point out, someone said to me the stock's down 30 cents. Your stock's up 22,000% in the last decade. Should we care about the last half hour?
Well, I guess we all do. You know, our growth is accelerating at a larger scale. That's surprising for people. And the end markets are really growing. You know, we've reached this point in AI called the inflection of inference. And so we've reached the inference inflection. And so, you know, our growth is accelerating. We would love to see everybody enjoy it.
Well, people got a little trapped by the 500 billion to a trillion, and I like that, over 2025, 2027. What trapped me was that when you said, when we were talking around with Michael Dell yesterday, that Jim, do you remember when I told you that ChatGPT could be big? And I said, well, yeah, I do, 10 years ago. And he goes, NemoClaw. He said, NemoClaw, this may be even bigger. I start my morning with NemoClaw. Could you explain to people why this may be what we're thinking about over the next 5 years and not something involving margins over the last 5 minutes?
Well, first of all, I said at the keynote, and I referenced a number I used previously because I want to give everybody a baseline.
We need that.
And so last year I said that about this point that we had $500 billion of high confidence visibility of Blackwell and Rubin. That's it. Obviously our company sells other things.
Right.
We have, you know, CPUs, we have storage processors, we have networking, and so we have all kinds of things that we sell in addition to that. We have $500 billion worth of visibility, and at this point, with another 21 more months to go to the end of 2027, we already have high confidence visibility of $1 trillion plus of Blackwell and Rubin. Not anything else, just Blackwell and Rubin. And so, you know, we still have 21 more months of new orders coming in. We still have all of the other things that NVIDIA sells. And so I just wanted to give everybody a baseline. The ecosystem needs to know directionally where NVIDIA is going. Now, of course, we plan with the supply chain. We help everybody with their capacity building. We prepare all the technology partners so that we can support $1 trillion worth of Blackwell and Rubin. And so it's an incredible thing.
You bought Grok in December.
Yeah.
What I heard yesterday, maybe my biggest takeaway, was that it's already going to be making you not money, but a huge amount of money, and that's not part of the trillion.
No. Yeah, we started production of Grok version 3. It's a really, really special company, and we're going to add Grok, not to every part. Vera Rubin is so incredible that it's really hard to add value to Vera Rubin. You know, that engine is so incredible. And so, but there's some part of the workload, I think about 25% of the workload, where we could add Grok to it. And so for 25% of the workload, we could increase our opportunity even more. And so
people will be paying for this. One of the reasons why I think is that everyone's so worried about high bandwidth memory and the cost. Don't get me wrong, but this kind of gets around that. The
we're
cost
the only
is going to be
company
lower.
in the
Your margins
world.
will be higher.
Yeah, we're the only company in the world that now optimizes the entire data center across 3 different types of memories. HBM, and we have some excellent partners there, HBM4 coming. LPDDR5, the world's first low-power memory used in data centers. We invented the whole idea. Everybody's going to use it in the future, but we're the only company in the world that optimizes around that today. And then third, we now have SRAM. So we have 3 different types of memories that we could optimize the workload across. And, you know, NVIDIA is really, really good at extreme co-design, where we optimize across all of these different technologies, building these AI factories.
And then at the same time, you talked about self-driving. Now, self-driving, that's 50 trillion. And you're going to get your share of self-driving. Yesterday, I heard a dominant share. I did not know you would dominate in that market.
We are going to be very, very large. You know, we've been working on self-driving for about 10 years now. Our strategy is not to build a self-driving car. Our strategy is to build a platform so that everybody can have self-driving cars. We partnered with Mercedes first. We're now on the road. It is the highest rated safety autonomous vehicle in the world today. And so I'm very proud of that. We're now also in BYD, the largest electric car company in the world, Hyundai, Geely, and Nissan. Among the four, consisting of all the five so far, that's 20% of the world's manufactured cars. And yeah, we have GM and Toyota on top of that. And so this is going to be our strategy is to help Uber and help all these companies create a large fleet of autonomous vehicles.
Now let's talk about the kind of robot that I didn't know I'd hear about, the agent robot. I saw yesterday for the first time that I have the opportunity to be smarter, to be able to create, to be able to do things I never thought, because I've got a new buddy with me.
Yeah.
It was viewed as soporific by the crowd. I thought it was explosive.
Yeah, it was incredible. You know, there's a guy named Peter Steinberger.
Yes.
And he created this thing called
He's
OpenClaw.
the first $1 billion whatever.
He created this thing called OpenClaw. It reminds me of back in the old days when Linux first came out, or Kubernetes first came out, or HTML first came out for the internet. These open standards at the time came out modestly. In the case of OpenClaw, literally overnight, in just a few weeks, it was able to achieve the most popular open source project in history, exceeding Linux, exceeding Kubernetes, exceeding every one of these open standards. And the reason for that is it's this simple to download one-line command, and you create for yourself an agent, basically a digital robot. Instead of asking questions like what and how and where, which is what chatbots can answer, you ask it to do build, create, help, organize,
Cure.
These are
Build a house.
That's right. Build, exactly. These are agents. These are basically an AI that can actually use tools and solve problems. It's
They're
incredible.
the fourth industrial revolution.
Well, that's the dream always, and OpenClaw made it possible. And now it's completely open source.
Well, I think you had to give everybody what they wanted yesterday. I think some took away an incremental notion. I took away an explosive notion and a wonderment notion. That's why I'm glad you're going to stay with me, because we're going to talk a little bit more about not earnings per share, but a new world.
Terrific.
A new world that NVIDIA is creating. And not just
it.
the world that made it so that you have so many millionaires.
You get to see it right here at GTC.
Well, I'm very excited. I know. One last thing I do want to just ask: are we still doing dirty, dangerous, and dull robots, so I don't have to do them?
You're going to do what?
The robots, they do dirty, dangerous, and dull things.
Well, they do things that either we can't do, they do things that we don't want to do, and they can do things all the time.
Well, then are they willing to clean toilets at Denny's?
Nobody could clean toilets at Denny's better than I can, but that's, you know, that's a gift.
Has there ever been a job that you were willing to do?
Everybody's good at something. That's what I was good at.
So, I mean, were you happy with yesterday?
Yeah. I'm proud of all the ecosystem partners here. I'm proud of all the announcements that we made. We revolutionized AI factories again, introduced a level of performance and energy efficiency by another 10x. And then if you add Grok to that, 35 times. And so I'm very proud of that. I'm very proud of the fact that all of these ecosystem partners here are helping to build this future industrial revolution. The number of companies that are here is incredible. Every single industry is represented, from healthcare to transportation to retail to manufacturing, right? It's just everybody's here.
Everyone
large companies,
is a client
yeah, it's
of
incredible.
Jensen Huang.
It's incredible.
We're going to have more with you, much more with you. Jensen's the co-founder and CEO of NVIDIA. You have to turn on Mad Money tonight to find out more, but it was explosive, not incremental, and that's why you must watch. Thank you, Jensen.
Thank you, Jim.
Jim, our thanks to you. We'll be sure to tune in Mad Money tonight, 6 p.m. for more on that chat with Jensen Huang. It is pretty fascinating, guys, this whole inference, the economics of inference and how that's creating a bit of an inflection point, reducing latency. And we've talked about cost per token so many times, David, but a 10x reduction in cost per token is what a lot of people are talking about.
They are, and we talked about it at the beginning of the 9 as well, because that conceivably could be a benefit for the users of those tokens, namely the OpenAIs and Anthropics of the world as well, which are constantly and trying to bring their costs down, and perhaps it also creates more of a moat even against competition from the likes of Alphabet with its TPU, or even Amazon and the Trainium, and some of the efforts that Broadcom is a part of in helping these companies design chips.
I mean, what we just got from Jensen was just pure confident bullishness about where they are and what they're selling, reiterating that last year at this time they were projecting $500 billion with high confidence visibility of Blackwell and Rubin sales, and now with 21 months to go, and he really emphasized this point and why this is such a bullish fact, high confidence visibility of $1 trillion plus of Blackwell and Rubin chips, and he said the new orders are still coming in. I mean, that is the sort of like overview industry bullishness that we look to Jensen Huang for, and you know, he delivered. I guess it's a lot of it is priced in with the stock not moving that much, but he sort of, you know, didn't give any reason to think that there was anything slowing down. In fact, quite the opposite. He talked about acceleration at a bigger scale.
Let's bring in Bernstein senior analyst Stacy Rasgon, get his reaction and overall to, you know, yesterday and that interview. I guess, Stacy, I would love to start off on this idea of the chips that are going to be way more efficient and what that means, and certainly what it means in terms of the competitive side of things with some of the names I just mentioned. Do you buy into that thesis?
I actually do. So I think there's 2 points. One is, I think unjustifiably so, NVIDIA has been viewed as an inference loser. Unlike their dominance in training, there's been this view that other players will be better equipped to dominate as inference becomes the driving force. And I have not been a believer in that at all. And I think what he showed us yesterday kind of proves that they probably can dominate inference to the same degree that they're dominating training. In inference, what really matters is cost per token. This is your usage. Right. And I mean, he showed it. He's been showing it, by the way. This is not new, but they clearly have the lowest cost per token, like by a country mile. I think that's only getting better, especially as they integrate some of these new architectures from Grok and everything else. And my hope is that as this becomes more and more obvious, that this view that they actually can be and are going to be an inference winner, I hope that can dominate. Maybe that's part of what can help getting the stock to work at some point. But I was really happy with what I heard.
You are. To follow up on that then, if they are going to dominate, does that actually make you think differently about AMD or about some of the other efforts in terms of custom ASICs that are out there?
Well, you know, it's funny. You know, he talked yesterday about that they're a platform company, and he's really right. And you look at everything that they're delivering on the silicon side: GPUs and CPUs and LPUs and DPUs and networking and storage and all this stuff. And on the software side as well, as everything is building up. And I mean, I have the same reaction every time. It's like, how can anybody else really hope to definitively compete with this? I think it's very difficult. And I think my views on that have really changed, especially in the GPU space. I think they've got a very big moat, and I think they have been, and I think will continue to be very, very difficult to compete with. It is still their game to lose.
Stacy, surveying some of the reaction this morning, I read some, I don't know, I guess disappointment on how supportive Jensen Huang was to copper versus optical or fiber. I wonder if you agree, and if that has implications for power bottlenecks.
Yeah. So, you know, the whole copper versus the optical debate has been going back and forth. And, you know, Hawk over at Broadcom made some comments the other day, and you know, I have the same view on this as I do on the whole like TPU versus GPU debate. Everybody always worries about which one's winning or losing, and frankly, from my side, I still think it's way too early to worry about that. I think the concern right now, the question right now is the opportunity still bigger? Is it not? I think there's still plenty of room for both, and he kind of said that they're going to be using both. I don't think that we have to worry at all at this point on copper versus optical or anything else, or frankly GPU versus TPU. Like, the market is growing. I think everybody who's in this stuff is probably going to be selling everything that they can make at this point. I think it's way too early to worry about which one's winning and losing.
So then how do you recalculate the total market here for NVIDIA and just how big its market cap can get?
Well, I mean, so part of the reason the stock has been, you know, somewhat stagnating is investor expectations have kind of already been there. But even that being said, I'm at, I can't, $12 or something next year. And so the stock's 15 times on my calendar 27 number. You got to really wonder, like, how much more can the multiple compress, especially since they are really showing no signs of slowing down. They are still accelerating. At some point, just on the earnings growth, I think this thing has to work. And in terms of the market, is it a trillion? Is it 2 trillion? Is it 3 trillion? Like, I don't know, but it's big. I think it's still clearly much bigger than where we're sitting right now. And I thought that the color that he gave on the order visibility, I think should be very helpful. And he's absolutely right. It's $1 trillion as a snapshot today, which should grow. And as he said, that was only for Blackwell and Rubin. They sell lots of other stuff, and they're going to be selling even more of that other stuff now with Grok and with everything else. Like I said earlier, I was very happy with what I heard. I'm really liking where it's sitting right now.
Finally, Stacey, I assume you're listening to the interview with Jim. I mean, they talked about autonomous cars. I don't know how deep you've gotten on that or what the real opportunity is there, but he seemed to be talking about a pretty big market. Are they a real player conceivably in the future in that?
I think they are, yeah. I mean, it's, they're, in terms of there's only a few companies that have like full stack self-driving solutions, and they're totally one of them. And they're really working on bringing that capability available to like a wide variety of customers to try to like drive that dominance. So, and frankly, self-driving cars, I mean, we're still early, but it's getting done, and it almost to me feels like a cracked problem. Like, I was always afraid back in the days to ride in one of these, and I ride Waymo now around all the time. I mean, this is a problem that I think is in some sense been solved, and it's ripe for ramp and ripe for adoption, and they should be in a good position, I think, to help stimulate and drive that and make it bigger.
Interesting. Stacey, always appreciated. Thank you.
You bet.
I like how Dan Ives put it of Wedbush. It's like watching Michael Jordan in his first few years of the Chicago Bulls. Just the beginning. That's how he views NVIDIA. After the break, airline stocks flying higher here in early trade. Find out why next. Plus, the market impact of an ongoing Iran conflict, from a new warning out of Honeywell to how it could be changing the Fed's rate path. We're going to talk about all the different spillover effects when we come back. Stocks are higher again today. We've got an S&P up about 0.5%. It's been a so far strong start to the week overall, and it's broad. You have energy leading. Oil prices are a little bit firmer today. Still watching what's happening in the Middle East with new strikes against UAE oil infrastructure, potentially raising prices. Brent's above 101. But the only sector that's down in the S&P right now is industrials. Everybody else is higher. Tech also leads. Financials are having a nice comeback day. Again, the tech trade being driven by Micron, Apple, Amazon, Palantir, some of the winners here in the early action. Time now for a CNBC News update. Seema Modi has it for us. Morning, Seema.
Hi, Sarah. We'll start overseas, where an escalation in the growing conflict between Afghanistan and Pakistan. A bombing last night in Kabul, claiming the lives of at least 400 people at a rehabilitation hospital in the Afghan capital. That's according to the Taliban, which is blaming Pakistan for the strike. Pakistan denying the accusation, saying it was conducting strikes in the eastern part of the country, but did not hit any civilian sites. In other news, Ukrainian President Volodymyr Zelensky is due in London today for talks with Prime Minister Keir Starmer as the European countries look to keep international focus on the Russian invasion while the war in Iran intensifies. NATO Secretary General is expected to join this meeting as well. And Warner Brothers Discovery CEO David Zaslav could make more than $667 million on the sale of his company to Paramount Skydance. That's according to a new filing. Additionally, he could be reimbursed up to $335 million for a federal golden parachute tax that would bring his total pay above $800 million if the deal closes this year. Worth noting, the merger is expected to lead to job cuts. Carl, I'll send it back to you.
All right, Seema, thanks very much. Still to come this morning, what's slamming shares of one AI high flyer in the early trade? Plus, Apollo's Torsten Slok is with us at Post 9, breaking down why he says there are no cuts coming this year.
Trend Tracker is sponsored by CME Group. CME Group, where risk meets opportunity.
Over 30 minutes here into the hour. Here are three big movers we're watching. Delta raising forecasts, now guiding for sales in the high single digits thanks to, quote, really, really great demand. That's according to the Delta CEO this morning on Squawk Box. Honeywell CEO saying at an industry conference that the Iran war could lead to a high single-digit hit to the company's first quarter revenue, but he does remain confident in hitting overall 2026 forecasts. And then shares of Nebius Group sliding sharply after announcing plans to raise more than $3 billion in a new debt offering this morning, following the NVIDIA and Meta deals. On Honeywell, guys, the CEO talked about how it's just hard to just tactically ship some of their products. He did call it a transitory, use the T word, issue there. And didn't say it was impacting volumes or demand, but just hard to get around with some of the blockages there, including in the Strait of Hormuz.
Yeah, it is good to start getting some guidance, though, as we are in the last days of the quarter. Coming up, Apollo's chief economist, Torsten Slok, will get his take on the market action tied to Iran and why he sees another pause from the Fed tomorrow. Plus, a can't-miss interview with Gary Cohn next hour. He was, of course, director of the National Economic Council during Trump's first term. We're back in just a minute.
Markets continue to rebound amid developments in the Iran war. Brent crude still sitting above the 100 mark, above 101 right now. Let's bring in Apollo Global Management Chief Economist Torsten Slok as we sit here on day one of a Fed day and try to figure out what kind of economic impact this is going to have and whether inflation is actually going to be the bigger side effect. What do you think at this point?
Well, the problem for them is that core PCE, as we speak, even before Iran began, core PCE was 3.1, and that's not 2. Their target is that it should be 2. We're at 3.1. And if you now begin to add the one big beautiful bill is beginning to kick in, we also have delayed effects of tariffs beginning to kick in. And on top of that, we now also have higher oil prices. It may be smaller in core inflation than headline. The Fed model would say that if you raise oil prices $35 a barrel, core PCE will go up only by 0.1. So that is a relatively modest impact, but it's enough, given the starting point is 3.1% inflation, that we are just moving in the wrong direction, and that just makes the meeting tomorrow, in particular, very complicated.
I know, but the inflation expectations, I showed the 5-year and the 10-year, they're not showing any kind of alarm that this is going to be lasting.
Well, of course, that's why in the near term they have to think about whether they want to categorize this as transitory. Do they want to go back to the previous description?
I don't think they'll use that word again.
No, that's what I mean. That's why it makes it very difficult. We just had 10 members out of the 12 voting members on the FOMC vote that they thought interest rates should not go down. And when you have such a big share of the FOMC saying interest rates should be unchanged, it's likely that they will also come to this meeting and say, if anything, the risk to inflation after the last meeting have actually gone more to the upside.
But you know what else the risk has gone to the upside is a higher unemployment rate.
That's true, but what's also the complication, as usual, there is that immigration restrictions have really slowed down. We used to have immigration of around 3 million people coming into the country from 2022 to 24. Now the CBO says that has dropped to around 500,000. So if immigration has slowed so much, that's also why we should expect their break even on non-farm payrolls to also be weaker. So that's why the challenge for them is the labor data, is that weak because of weaker labor demand, or is it weak because of actually weaker labor supply? And there's a lot of arguments why it really is labor supply that's driving why non-farm payrolls has been so much weaker.
Getting some relief in shelter, are we not?
That's true. So that's the one good silver lining. The things are pulling things down on the inflation front from housing, but all these other components that have been really hibernating a bit in the background, in particular, of course, energy, are now beginning to show more signs of life. That's also, if you look at core goods ex autos, that has really started moving up, especially over the last year after the trade war began. So a number of the other components are beginning to move in the opposite direction. So as usual, it is a bit up on the scale for them, thinking about what components are going up, what are going down. But it's very clear that, to Sarah's point, they must also look even at short-term inflation expectations and begin to worry about, we don't want them to go up too much.
When you look at the forward oil curve and you look at December pricing around $75 a barrel, do you think the oil market is gaming this outright?
Well, I do think that we should probably view this as something that is in some form at least more temporary. So from a Fed perspective, it is likely a more transitory stock. It's definitely much more transitory shock relative to AI. Then we can discuss what's going on with software in credit markets. We have now longer periods between recessions, so therefore we do maybe have some mini cycle in some certain sectors. But those mini cycles can happen like they did with energy, like in 2014. We had commercial real estate in 2022. So yes, there may be episodes in certain sectors where things are taking a little bit of time to work out. But at the macro level, we have very strong tailwinds to growth from AI spending, from the industrial renaissance, meaning the political desire to homeshore a lot of production. And we also have really strong tailwinds to growth coming from the One Big Beautiful Bill. The CBO estimates that it will lift GDP growth by almost a full percentage point. So the Fed is set up with high inflation already, now more upside pressure from oil prices, and likely also strong growth over the next several quarters.
Why do you think recessions are happening with less frequency? What's happening?
Well, I think that the policymakers have just become much better at managing things. That's why both monetary policy and also fiscal policy have now done more to try to immediately address the challenges once they arrive. That's what we saw in 2020. That's what we saw in 2008. It may not be every time as successful as they would like, but at least their willingness to respond has just been much more aggressive, much more immediate than what we had back in the 1990s and even in the 2000s.
You mentioned growth from AI, from spending on AI, but how are you viewing the productivity increases potentially as it starts to really embed itself in the enterprise and back to employment, how it's going to ultimately impact it?
Yeah, this is very important. So there's been a number of different papers and seminars more recent on this. If you look back at what was discussed at the seminar at the Brookings last week, where there were 3 experts discussing what's the impact of AI on the labor market, their conclusion was from all 3 of them that so far we're seeing literally 0 impact in aggregate. There are certainly something about job openings, something about young graduates, but in aggregate at the macro level for the Fed, I really think that Jay Powell is right when he at the press conferences repeatedly has said, well, there is no sign yet of this in employment, in productivity, and in inflation. So yes, it may be that this will generate huge productivity gains going forward. It may also not be.
It may not be, and this is obviously part of an ongoing conversation that we've already had to a certain extent, but what are your expectations? It's only the very beginning here, but things are changing very quickly. The enterprises are starting to adapt some of these tools.
Absolutely. So the question now becomes from a market perspective that if it is the case that some of this comes in waves, I have people coming into my office and saying, well, maybe we'll have a little plateau for 1-2 years and then we'll go up again. We should all be saying, well, if the implementation comes in waves, maybe valuations will also come in waves. And that means that who the winners will be, who the losers will be, is just really difficult to point out at this stage because we may have plateaus. We thought last year that some companies were the winners. Now we think other companies are the winners. What are we going to think in 6-12 months' time? It's going to be a very difficult exercise of figuring out who is it that's going to get disrupted and to what degree, and therefore ultimately who will be the big winners, and therefore will we get those productivity gains, David, that we're talking about.
Really quick, where do you see unemployment topping out?
So if you look at the consensus, which is really important about this discussion, the consensus expects unemployment by the end of this year to be 4.2. That means the consensus expects unemployment to come down. We're sitting here worrying about, oh my God, or maybe we're all becoming unemployed. And at the same time, all the 60 people who submit the numbers to consensus, they're saying, just like the Fed is saying, you know what, maybe we should really be worrying.
I think they're just late, though. I think they just need to catch up.
It could be. So that's question whether the economists are right or whether the techno-optimists are right. And that's what we're all trying to figure out.
Okay. Economists aren't usually the right ones.
They are not, or they are?
Thank you, Torsten. I appreciate it. Torsten Flock from Apollo.
When we come back, the president hosting the Prime Minister of Ireland at the White House, taking questions from reporters in a moment. We'll get the latest from Washington when Money Movers begins in just a few minutes.
Money Movers. I'm Sarah Eisen with Carl Quintanilla, live from Post 9 of the New York Stock Exchange. Today, the Iran war's impact on the American economy, for the outlook, for the Fed, what it all means for the midterm elections. Former NEC Director Gary Cohn is with us.
Plus, could nat gas see far longer-term consequences from the Iran war than oil? We'll get to that story.
And NVIDIA CEO Jensen Huang giving more details about the company's revenue projections in an exclusive interview with our Jim Cramer just a few moments ago. We'll get the street's reaction in just a few minutes.
Pretty nice rally for the second day in a row here. It's quite strong breadth-wise. VIX close to 21, the 10-year below 4.2. We've held that 200-day moving average around 6,600. And the only sector at the moment that's lower is healthcare. Interesting downgrade of Lilly today to reduce over at HSBC, arguing that the obesity market, TAM, might have to be brought down a bit.
Yeah, and even healthcare stocks are pretty flat on the news. I think it's interesting that the stock market continues to climb the wall of worry, even on a day where oil prices are firmer. So that hasn't necessarily been the case. It's usually high oil. You see higher treasury yields and weaker stocks. Not today. So there's just a lot more sense of calm in this market, which we saw yesterday and here today with oil. I mean, Brent is over 101. It's up 1%, so nothing extreme, but we're still watching out for these attacks on energy infrastructure in places like the UAE
and
today.
Tankers too, yeah, diesel above $5. Haven't done that in a few years. Let's get with the latest in Iran. The president is expected to take questions at the White House in a few moments while he hosts the Prime Minister of Ireland. Let's get to Eamon Javers in D.C. Morning, Eamon.
Yeah, good morning, Carl. We're waiting, as you say, for President Trump to hold a bilateral meeting in honor of St. Patrick's Day with the Taoiseach of Ireland, Michael Martin. You know, typically this is a friendly meeting with an overlay of economic engagement, but today the U.S.-Irish relationship is strained by tariffs and war in Iran, so this could be a trickier meeting than we've seen in years past, so we'll keep an eye on it. Meanwhile, the president is dealing with the first major defection from his administration over his decision to go to war in Iran. Joe Kent, the director of the National Counterterrorism Center in the Office of the Director of National Intelligence, posted his resignation letter to President Trump online this morning, saying, quote, "I cannot in good conscience support the ongoing war in Iran. Iran posed no imminent threat to our nation, and it is clear that we started this war due to pressure from Israel and its powerful American lobby." Kent went on to say that he believes high-ranking Israeli officials and influential members of the American media deployed a misinformation campaign, creating an echo chamber that deceived Trump into believing that there was a clear path to swift victory. This was a lie, Kent wrote. Now, he said that as a veteran who deployed to combat 11 times and as a Gold Star husband who lost his wife to what he calls a war manufactured by Israel, Kent cannot support sending the next generation to fight and die in a war that serves no benefit to the American people. Now, Kent's late wife, Shannon Kent, was a Navy officer, military cryptologist, linguist, and intelligence team member who was killed in a suicide bombing in Syria in 2019. Now, we expect to see Kent's boss, the Director of National Intelligence, Tulsi Gabbard, testify on Capitol Hill later this week in a long-scheduled hearing on worldwide threats. The resignation will likely be a central piece of questioning from Democrats in that hearing, and we'll watch to see how the president handles questions about it if he gets them in the Oval Office in just a couple of minutes, guys.
Yeah, I mean, I guess, Eamon, how significant is this? I'm just surprised, like the whole blaming Israel on this, you know, is pretty insulting to the American president.
Yeah, it is. You know, Kent, you know, the National Counterterrorism Center is a high-ranking office, but it's not the most senior, you know, position in the intelligence community for sure. So sort of calibrate that in your mind as you think about it. This is not the kind of resignation letter I've ever seen before. It's clearly somebody who's angry and frustrated, has suffered a lot of personal, you know, he suffered a lot personally over the years. He clearly is an opponent of what, you know, the president campaigned on, or a proponent of what the president campaigned on, ending forever wars, and is frustrated by this decision. You know, Kent is somebody who's very close with Tucker Carlson. The New York Times just posted a brief interview with Tucker Carlson praising Kent for this decision to resign. He's also a failed multi-time congressional candidate, so he's got sort of an elaborate backstory, and the tragic death of his wife obviously is front and center in that backstory. So we'll wait and see how the president decides to handle this one.
Yeah, the Tucker detail is important too, who's been lobbying against this war. Thank you, Eamon. Eamon Javers, we'll keep you close in case we hear from the president. Let's turn now to the macro environment. Here with us at Post 9 is the former director of the National Economic Council during President Trump's first term, Gary Cohn. He's also the former president of Goldman Sachs and current vice chair of IBM. Welcome back. It's good to have you.
Always good to be here.
How are you thinking about some of the implications for the market around what's happening in Iran?
So I think you have to start with the basic issue of supply demand of some of the most important commodities in the world, whether it be nitrogen that we're not talking about as we head into the growing season.
Should we be talking about nitrogen?
We should be talking about nitrogen.
Why?
At the end of the day, it's fertilizer. We know the impact of fertilizer on growing crops. We're getting close to starting to plant crops in this country. And without nitrogen, without fertilizer, we will have diminished yields. And again, it's a yield game. We're talking about oil, and I think talking about oil is important. One thing that we should note, though, and I think we got to be complimentary, we in the United States do not have a supply problem. This is one of the first crises that we've ever lived through in this country where we haven't had a supply problem. We didn't have to worry about molecules. Yes, we're part of the global pricing mechanism, so the price has gone up, but the supply is not going down. If you look at some of the Asian economies right now, they're literally shutting down businesses, shutting down schools, shutting down government because they don't even have supply at any price.
That's why I'm so confused as to why our European allies wouldn't want to help us, given they need oil more than we do.
Well, Sarah, they do. They're the ones paying the price right now, and they're the ones that need the oil. On the flip side, trying to weigh this as I try and do, come up with a reasonable answer, they were not informed about this invasion. They did not know about it. They've also had a bit of a contentious relationship with the White House during the past year. Whether it be over tariffs, whether it be over Ukraine, whether it be over all these things. Look, at some point, though, your own economic stability has to outweigh the other issues going on. So like you, I'm a little bit overall surprised at some point if they don't engage with us. Look, you also have to understand that the Europeans, and we saw this in Ukraine, have had a real apprehension to getting involved in any conflict whatsoever. They've been sort of adverse to that. So, but again, we've got a reality here, and sometimes when you're forced with a realistic decision of am I going to shut my economy down, am I going to slow my businesses down, am I going to curtail, and there's a solution to it by getting involved, maybe they come to the solution of getting involved.
I mean, they would say it's not the solution, that you're not going to get something with the European frigate that you can't get with the U.S. Navy, and yesterday the president said we don't need them anyway.
Yeah. Well, the president has gone back and forth on this.
Yes, he has.
And I think it would be great symbolism for the other countries to get involved in a disagreement that has caused them strife as well. This is not just a country that's anti-American. This is a country that's anti-capitalism, anti-wealth, anti-progression, anti-gay, anti-everything. So if you think about it from a European standpoint, they've got to stick in this game as well.
Right. So back to the sort of economic impact for the U.S. I mean, you know oil. You started, right, as an oil trader?
I did.
Right, way back when. If you would have said that they closed the Strait of Hormuz, which is 20% of the world's production right now, that there are attacks on oil infrastructure and facilities in UAE, in Kuwait, attacks on Saudi Arabia, and Brent is at 101. Is that surprising? Should it be higher?
It's not totally surprising to me. So, I don't want to get too deep in the analytics here, but we are in what's called the shoulder season of the year. We're not in a heating oil season, and we're not in a heavy air conditioning season. So normally you would see refineries starting to go down for maintenance. Refineries would be shifting their refining mix over from heavy heating oil to very lighter fuels that we have. Some are driving fuels, some are difference in gas. So if this were happening in the middle of the dead of the cold of the winter, or this were happening in August when we were burning maximum energy for electricity, you would have a little bit of a different outcome. That said, we also, the United States has changed its position. We used to be one of those very dependent importers. We're now a dependent exporter. We're a huge exporter of LNG, which is our oversupply of natural gas. So there is more of a balancing mechanism, and the world's gotten more efficient. I think our overall demand for oil today is dramatically lower than it had been at any other time when we had a major disruption. And so whether it's EVs, whether it's natural gas, whether it's windmills, you have to factor all of the alternatives into the equation. And so the direness of the cutting off of 20% of the oil today is not as dire as it once was. Russia's producing as much oil as they have in a while. Interestingly, we lifted the sanctions on Russia. Russia can continue to ship oil. And so there's a bit of a balancing going on the demand side that's come off since last time we had really troubled supply side.
I wanted to read you what Tony P. over at Goldman wrote today about equities. It strikes me that the view of folks who are closest to commodity supply chains, i.e. the black belts who know these markets deeply, seem to be the most negative. Do you think that's true, being one of them or a former one of them, and looking at how equities have taken all kind of this in stride?
I don't know where I fall in this in Tony's world. Look, I think what the people that grew up in the commodities world know is we know that if this whole war were to end tomorrow, the skirmish were to end tomorrow, we'd open up the Straits of Hormuz. It's not turning on a spigot. We've been down long enough where countries have had to shut in production, they've had to curtail production, they've had to slow down. So the world's not going to reset back to prior export limits overnight. It's going to take some natural evolution of turning back on refineries, turning back on oil wells, turning back on pipelines, and just all the congestion of ships in that part of the world. It's going to take, you can only load a certain amount of ships at a time. And so it's going to take more time to unwind this. That said, and I think that said is important, I think people are pretty optimistic right now overall. And to the extent that it gets worked out and there's a more defined period of time to when we normalize, I think the more bullish people are. So that sort of offsets, people like me that grew up in shipping oil around the world and understand the logistics of it. I think the reality of knowing there's an end probably overwhelms the reality of the supply showing up a week or two or three later than you would have thought.
What do you think about the economic hit? Is there going to be one, and how substantial?
Is there going to be
an economic hit?
Well, I would say we're having a bit of an economic hit. We're clearly having inflationary trends run through the economy. I think consumer confidence is getting hit to some extent. And we're seeing less and less consumption, especially in the middle to lower wage population, which is a story we've been talking about for the last year. We've been talking about, the unemployment picture. We've been talking about the consumption at the lower wages population. And when you go through times like this and you go through stress and you have prices rise, if you're on a fixed income and you're spending an extra 50 cents a gallon for gasoline, that's being taken directly out of your disposable income, and you're able to consume less goods and less services. And so I think the American consumer today is feeling that. So we are having economic consequences today.
And how bad do you think it'll get?
I don't know
how. Does it change your view of recession odds, for instance?
It doesn't really change my view of recession odds right now. There's so many other stimulus coming through. Like Torsten mentioned, we've got the big, beautiful bill coming through. We've got tax refunds coming through. We're in a period of time where there's enough government spending and enough government stimulus around where I'm not worried about a recession. But we've been having this discussion for 5 years now.
You're never worried.
I've been on the opposite side of you for 5 years, so I just want to make it clear.
Lately, there's been no sign.
Well, because Torsten put out a piece today that talks about
no more recessions
the infrequencies of recession now. So I'm not worried about a recession, but I am worried about the overall consumption flywheel in the United States. As the longer people are spending an extra 50+ cents a gallon for gasoline, it's coming directly out of their disposable income. And we all know that gas inflation is the single worst inflation we can have because people get out of their car or truck, they hold the nozzle down, and they watch the numbers tick. And they knew exactly what they paid last week, and they knew what they paid the week before. And if they're paying $20 or $30 extra this week, that's
but 20. But it's only 3% of their overall.
It is and it's not. If you look at, sort of middle income America or lower income America that lives in more rural places, that drives their pickup truck to work 100 miles because they live 100 miles, it has a dynamic impact on their consumption capabilities and also everything else that's getting delivered. The price of leisure just went up. Airline tickets are going up. Even though there's good demand, airline tickets are going up. The price of getting something delivered to you is going up. The price of baking is going up. It's all trickled down through the economy, and it may be 2 or 3% here and 2 and 3% there, but those 2 and 3% add up to really drive people to different short-term consumption patterns, and it also drives people to have less and less confidence in themselves, so they tend to spend as little as they possibly can.
You mentioned the pressure on some of these Asian countries. The Gulf states are in a different position than they were a few weeks ago. Does that change their CapEx commitment resolve or their investing resolve in either the United States overall or the AI build out or something different?
I think it doesn't change. I think they will continue to invest. The one thing we know, they're going to invest a lot more money in military equipment and defense equipment. So, you know, the one thing we've all learned is the state of military war fighting has changed, and being prepared for drones and being prepared for drone warfare and having the infrastructure permanently there in the Middle East is particularly, we are going to see major capex in that area. I don't think it will stifle any of the investment that's going on in the data centers, in AI, in growing their economy. You know, fortunately, they're beneficiaries of this oil price if and when they can sell oil. Now, no one's really harvesting that much of this price right now. The Russians are probably the biggest beneficiary of this because they're the ones actually selling oil right now. In the Middle Eastern countries that normally flourish as oil prices go up, they're not flourishing because they're not selling.
What do you think the Fed does with all this?
I think the more interesting thing coming out of the Fed is we're going to get dot plots tonight, or scattergrams, as I've been calling this, because they don't make a lot of sense. Well, I guess they do make sense to the people doing it. So I think what we're going to learn tonight is we're going to learn what people's forward projections are. And I think those forward projections will be a telltale sign of how people think about what's going on in the Middle East and how quickly it will end. The longer it goes on, I think the higher you would probably leave your interest rate forward curve. The quicker you think it's going to end, you probably are more inclined to potentially talk about lowering rates, meaning that this inflation bump is a bump, and meaning that we've got an unemployment picture that's not rosy, and you could get yourself to a position where cutting rates makes more sense if you thought this was a short-term event.
So at this point, what, one cut this year? That's what the market's pricing in.
Yeah, I think the market's probably right. I think that when we get a new Fed chair, Kevin will come in and give us what he's promised. He'll give us a cut, but at the same time, he will start selling down the balance sheet. So, you know, you maybe get a cut in the front end, you'll provide securities, extra supply securities in the back end. I don't think the front end cut lowers overall interest rates on the curve. So it doesn't do a lot for home ownership. It doesn't do a lot for credit cards. It doesn't do a lot for automobile loans because those are priced on the 5 to 7 to 30-year part of the curve. And I think that part of the curve is going higher, not lower. We're going to see more, I believe we see more steepness in the yield.
Then what's the point? Then tell him not to shrink the balance sheet.
Well, but Kevin, I agree with Kevin that the Fed was never meant to have a massive balance sheet. It bought the balance sheet when it was trying to stimulate economic activity when we were back in the zero interest rate environment. So now that we're in the higher interest rate environment, we can sell it down. But overall, if I'm the Fed chair, you would want less of a balance sheet. You would want to have the ability when things got tough to have the dry powder to use the balance sheet effectively. And I think Kevin, having lived through 2008, and sort of arbitrated all of the different bank discussions in the mergers, potential mergers, and failed mergers, he understands the importance of having a balance sheet to lever up when he needs to.
Right, but he also understands the impact of lower interest rates on people who need it most.
He does. But look, newsflash, the Fed has never been able to influence any other interest rate except Fed funds, which is the overnight rate that banks charge each other. The market determines everything beyond Fed funds. It's all market driven. Now, will the Fed put some influence in that market if they sell their balance sheet? Yes, they will have some undue or due influence on selling down that balance sheet. And I think Kevin and the other Fed governors will have to make a decision. Is selling down that balance sheet to give themselves dry powder in the future worth it if it steepens the curve in the short term? And I think they probably will come to the conclusion that it is worth it.
We're going to be talking a lot more about that in the months ahead. Gary, thank you very much for joining us.
Thank you.
Always a treat. Gary Cohn.
Nice 20 minutes with Gary.
Wow.
Still to come this morning, NVIDIA's Jensen Huang joining the show last hour with Jim. We'll bring you the key comments, plus how the street's reacting to this revenue outlook through 2027.
At this point, with another 21 more months to go to the end of 2027, we already have high confidence visibility of $1 trillion plus of Blackwell and Rubin. Not anything else, just Blackwell and Rubin. And so, you know, we still have 21 more months of new orders coming in. We still have all of the other things that NVIDIA sells. And so I just wanted to give everybody a baseline. The ecosystem needs to know directionally where NVIDIA is going.
Welcome back. NVIDIA's Jensen Huang says the company's revenue could hit $1 trillion through 27, but the stock reaction was muted yesterday. Christina Partsinevelos is at GTC in San Jose, joins us with more on the street's reaction to yesterday's event. Hey, KP.
Hi, Carl. Well, Jensen Huang, the CEO, spent literally 2 hours and 15 minutes on stage making the case that NVIDIA's best days are still ahead. The headline number you mentioned was at least $1 trillion in cumulative revenue through 2027, which was double the previous figure that we got back in October at their GTC DC. That sent shares initially up over 4% higher in just minutes. Then investors did the math, thought maybe the acceleration really wasn't there, and NVIDIA lost roughly $150 billion in market cap in just the span of about 10 minutes as enthusiasm just faded. The problem is that $1 trillion isn't that far from where Wall Street already was, so the new number barely moves the needle. Mizuho's Jordan Klein writing that GTC risks becoming maybe overhyped and an annual snoozer that moves nobody, drawing a direct comparison to Apple's iPhone event in September. A little harsh. JP Morgan, though, pushing back, though, saying NVIDIA's platform, now spanning 7 chips and 5 rack systems with the software to tie them all together, is just simply too difficult for any competitor to replicate. And with demand broadening beyond hyperscalers into sovereign AI, enterprises, industrial customers, the cycle is more durable than the market is actually giving it credit for. Jensen Huang, the CEO, backing that up on CNBC just in the last hour with a comment specifically geared towards memory. Listen in.
We're the only company in the world that now optimizes the entire data center across 3 different types of memories. HBM, and we have some excellent partners there, HBM4 coming. LPDDR5, the world's first low-power memory used in data centers. We invented the whole idea. Everybody's going to use it in the future.
So for memory investors, that's a direct call out to names for high bandwidth memory suppliers like SK Hynix and Micron. Even SanDisk is climbing higher today on a signal that demand is about to accelerate, even though supply is just still so tight. Morgan Stanley's Joe Moore calling the sell-off an attractive entry point right now and keeping NVIDIA as his top pick in semis, saying the market will eventually get more comfortable with this 2027 growth number. And when it does, the stock will outperform. The setup is there. This is according to him. The market just needs to believe it. Carl.
I mean, it does speak, Christina, to this disconnect between the commentary and the bullishness we get from Jensen Huang and the analyst community, which has all stepped in and been equally bullish. I mean, we heard even Stacey Rasgon, who's been, skeptical before. He loved what he heard and said that he doesn't think the stock can get much cheaper. And then the market, which is showing a stock that has been in a range and barely moves on this kind of update.
Yeah, it's Sarah. So every day as a reporter, I have to put a pitch in, and that was exactly my pitch, the disconnect between the generalist market and then the entire chip community, which is, there's nothing that can, sway their opinions about how strong they believe NVIDIA is. I think the problem with the general market is that the upside is no longer there. This is a massive company, right? So to swing it even higher, you really have to move the needle. So I think that a lot of investors are thinking there's more upside in the supply chain as opposed to just NVIDIA itself. And so I think that's a difficult point for the CEO, Jensen Huang, to really have to sway the market and say, like, oh, look, we can go to $5 trillion just within the next year or so. And I think the market isn't convinced that such a big company can move even more despite the demand being there.
Okay, Christina, thank you. Christina Partsinevelos with NVIDIA stock down about 0.25%. Still ahead, while the impact on oil is grabbing headlines, the war in the Middle East could have a much longer-term impact on natural gas. We've got that story after the break.
NVIDIA is not the only chip name on the move today. Qualcomm with a new $20 billion buyback program, boosting the dividend 3% to 92 cents. Shares are up about 2% right now in a decent tape with the Dow up 230. Stay with us.
Welcome back. Watching oil this morning. Brent back above $101 a barrel as investors try and digest information about whether ships can pass through the Strait of Hormuz. But oil might not be the only energy source feeling the impact. Pippa Stevens is here. Good morning, Pippa. Natural gas also in the crosshairs.
That's right, Sarah. But let's start here with oil because it is higher after a fresh round of Iranian attacks on UAE energy infrastructure and as a tanker was hit in the Gulf of Oman. Also lingering questions about if and when there will be military escorts for tankers in the Strait of Hormuz and which countries will send support. But longer term, the liquefied natural gas market could have larger lasting impacts from the blockade than the oil market because LNG production is much more concentrated. Qatar supplies about 20% of global LNG, which comes from Ras Laffan, which has been offline since March 2nd. And the longer it sits idle, the harder it is to restart. Alex Munton from Rapidan telling me Iran's first hit on the facility was a warning shot. If they wanted to do major damage, they could, since Ras Laffan is essentially a sitting duck. Now, nearly 90% of LNG that passes through the strait heads to Asia, where buyers are now scrambling to make up for lost cargoes. JKM pricing topping $20 per MMBTU, which is enticing some ships initially bound for Europe to U-turn and head to Asia instead, where they can get better prices, just as the European gas injection season begins. Guys?
Meantime, Pippa, I think also interesting is the rig count here back at home. There's been a lot of discussion about how the majors are going to kind of wait this out. And certainly we've only added, maybe 5 from the lows?
That's right, Carl. So when you look out future down the curve, which of course is now in backwardation, for the end of the year, WTI is sitting around $70. And so it's not as if this front month spike at this point is translating to higher prices down the curve. But I think it's also the question of what oil and gas drillers hate the most is uncertainty. And right now there is a big question mark around how long this is going to last. And so they're not going to drastically increase plans to boost output right now when there are so many questions about what the supply-demand dynamic will look like in the back half of the year. And of course, when you think about the administration's policy proposals, they are not at this point floating anything along the lines of an export ban. But, you know, that has been mentioned at times like this by several people. And that can then also lead to issues about, you know, what is happening domestically and the fact that while we are a net exporter, we can't always get our products and our oil to where we need it to be in the U.S. because these are still very much global systems. And so when producers are looking at their production plans looking forward, they're not at this point going to say we're going to increase output when there's just, you know, no certainty right now about where oil is going to be come the back half of the year.
Yeah, it's going to be really interesting to get guidance from the majors in the coming weeks once we wrap up the quarter and see where their head is on all of this. Pippa, thank you. Pippa Stevens. Let's get a CNBC News update with Seema Modi this morning. Hey, Seema.
Hi, Carl. Apple CEO Tim Cook quashing speculation today that he's leaving the company, telling Good Morning America, quote, "I can't imagine life without Apple." His comments follow recent reports that he was preparing to retire. Apple's going through a tough stretch with some C-suite resignations and continual pressure to deliver on delayed AI promises, including a revamped Siri. The Vatican Appeals Tribunal declared a mistrial today in the so-called trial of the century meant to crack down on financial misconduct. The late Pope Francis brought charges over alleged financial crimes against a cardinal and several other people, but the tribunal ruled that the late Pope and Vatican prosecutors both made procedural errors, nullifying the original indictment. A new trial is set to begin in June. And Iran's Football Federation is reportedly in discussions with FIFA to move its World Cup matches from the U.S. to Mexico over safety concerns for players. Last week, President Trump said Iran was welcome to participate, but that it might not be appropriate for them to play in the U.S. for their own life and safety. Sarah and Carl.
Okay, thank you, Seema. When we come back, Lazard Asset Management CIO on the risks he says the market is overlooking right now. That's next.
We'll get to this move in Delta today and some of the other airlines. Got some new guidance, some comments about the consumer. Helping those shares out today are at least, up almost 5%. We're back in 2. Welcome back. Market trying to continue its rebound today as oil prices do move a little bit higher. Joining us this morning at Post 9 is Lazard Asset Management Chief Investment Officer Eric Van Nostrand. Eric was also former Assistant Secretary of the Treasury for Economic Policy under the Biden White House. It's good to have you back. Thanks for coming in.
Good to be here, Carl.
Sounds like you're a little surprised that oil hasn't risen more than it has.
Yeah, I think, both in terms of the stock market reaction, which has felt good the past 48 hours, but in general, we've been in a tough couple weeks. As painful as that's been in the moment, I'm surprised that risk hasn't reacted more negatively to this kind of a persistent conflict. And as shocking as the uptick in oil prices has been, I'm surprised it's not higher, frankly, given the amount of disruption at stake.
You think it's reflecting optimism about the Saudi bypass, the possibility of escorts, what Iran's letting through anyway?
I worry, Carl, that it's actually a little less nuanced than that. I think markets are actually infected with a bit of recency bias from the 2025 Iran-Israel episode, where investors were rewarded for looking through a lot of the geopolitical disruption. In fact, most investors working today in their lifetimes, you've usually been rewarded for betting against geopolitical disruption. This feels different, though, given the likely persistence of the conflict.
But, I mean, do you think that there are actually moves happening by businesses, by oil producers, because everyone is sort of looking at this as a temporary issue?
I think that confidence is what's keeping the price action as muted as it's been. But I think if you look out past the short term, we see corporate leaders being cautious about their near-term investment decision-making.
You do?
Based on
That's happening?
That's something that's been in the background for, a while, given the United States' changing relationship on economic policy with the globe. But it's really been exacerbated by this conflict. And it's been especially exacerbated by the massive supply shock that we're seeing in energy markets, and in my view, are likely to continue seeing.
So you see an earnings issue?
Well, I think the biggest effect right now is the aggregate supply shock from oil. One way to think about the optimistic earnings narrative over the past year or two is that AI has been a positive supply shock, a productivity boom where we can make more stuff and do less work. The oil shock that's happening now is in some sense the opposite of that. It's a supply contraction where there's less stuff available to do economic activity with. And that is going to weigh on earnings. It is going to weigh on sentiment.
That's sort of people are drawing the line between the energy disruption and AI, which is hugely hungry for energy, and what that does to semi-fabs in Asia and eventual prices on memory and maybe the build out. You think it's that clear?
I think it speaks right to one of the more important conceptual points about the way the market's been evolving over the past couple of years. But, most of my career, most of our careers, market watchers have been focused on demand management. Is the Fed going to cut? Is the Treasury going to bail everybody out? The past couple of years have been about supply risk. On the upside from AI, on the downside from some of these policy shocks like tariffs, immigration, now a major oil disruption.
Right. What about private credit? You think there's still this brewing theory that this goes along long enough, it will feed more cracks in private credit, even more than we've seen prior to hostilities?
I think some of the concerns over private credit to date have been a little bit overstated in the narrative because we've seen some defaults, and some defaults are healthy, but right now the people suffering are the people who were paid to take that risk, the lenders who were compensated for taking that risk. What I'm watching in terms of private credit is contagion risk. When are public credit markets going to move in response to it? When are you going to see a broader risk-off narrative coming from it? And I don't think we've got evidence of that yet.
Right. Yeah. We keep watching CDS and default rates and haven't seen anything too disturbing at the moment.
It's a real risk, but it hasn't affected other markets yet, which is my test for when to get very worried.
So overall, I mean, at Lazard, you're telling your clients to do what now?
So at Lazard, we're focused on identifying the companies underneath the macro risk that are likely to generate persistent earnings aside from the macro disruptions. So what we're doing with the money entrusted to us by our clients and in our conversation with clients is urging them to look for companies that have resilience in their earnings line, that aren't overly leveraged to near-term input costs.
Like who?
Because, I think generally companies that aren't exposed to oil in particular as a large input, particularly companies that are based more on consumer demand, but don't spend a lot of time making investment decisions that are very oil sensitive, are places that'll look past the current disruption.
Eric, we'll see. It's only 17 days in. Good to see you. Thanks for coming in.
Good to
Eric von Nostrom.
After a break, some of the top names in private equity weighing in on the recent software slump. Speaking of, we're going to bring you those comments live from the Thoma Bravo investor meeting in Miami happening today. We're back in just a moment. Take a look at shares of Honeywell, down about a little more than 2% right now after the CEO spoke at an industry conference in London this morning. Honeywell clarifying earlier reports that full-year revenue would take a hit from the Iran war. The company says a high single-digit percentage of sales comes from the Middle East, but it does not anticipate a meaningful impact to revenue. So clearing up some of the questions there about whether this would be a financial hit.
Meantime, some top industry executives weighing in on the recent software sell-off. Our Leslie Picker is at the Thoma Bravo investor meeting in Miami. Morning, Leslie.
Hey, good morning, Carl. Yeah, software companies here are going on the defensive. You can see each one has a booth with a desktop, and they're using that to show Thoma Bravo investors exactly how they're pivoting in the world of AI. We actually sat down with the Proofpoint CEO a short while ago, who today launched a new cybersecurity product to combat AI risks, and he said this is an example of how AI is benefiting traditional software.
From an investor's perspective, it's a confusing time because there's this sort of broad brush that everything has been painted with, where all software is all of a sudden being put into a question mark due to AI. It's confusing because not every software can be put into the same bucket. The need for cybersecurity in the world of AI goes up, because now all of a sudden it's not just humans and other traditional systems you have to protect yet another thing, and the risks of compromising AI are extremely high.
We also spoke with a Thoma Bravo investor, the head of PE for CalPERS, about how he's thinking about software buyouts amid all of the volatility and negative headlines.
There was underwriting done in the software sector that didn't contemplate some of the changes that we're seeing as soon as we're seeing them. And the market is trying to process that. Now, we do think our firms are well equipped to adjust their portfolio companies insofar as there are certain ones that are more threatened by AI. And as a result, to be able to reposition them, perhaps turn it into a strength.
And he actually said he'd rather have software companies reposition as private companies versus be pressured with quarterly numbers as public companies. And he said he sees their venture book comprised of AI companies as a, quote, natural hedge. Now, guys, I'll be sitting down with Thoma Bravo founder and managing partner Orlando Bravo in about an hour from now. There's, of course, so much to discuss with him in terms of software disintermediation, what's going on in private credit, and, of course, how he's navigating all of this volatility, guys.
All right, Leslie, that's a key interview. Look forward to it. Our Leslie Picker in Miami today. Meantime, Delta is one of the top gainers on the S&P this morning. We'll get into what CEO Ed Bastian told our Phil LeBeau about why the company is raising guidance, at least on the revenue side, on the other side of this break.
watching over the last couple of weeks, and all of our NATO allies were very much in favor of what we did. They thought it was very important. We were just discussing it, actually. Very important that we take out the nuclear threat from Iran, and we've done that very strongly, very powerfully. We've wiped out their Navy, wiped out their military in every aspect. Their Air Force is now decimated. They have no Air Force, no Navy. They have no radar. Their radar is entirely gone. Their anti-aircraft machinery is gone. Everything is gone. Their leaders are gone. I guess one of their top person was, they say, a lot of people say their actual top was killed yesterday, along with somebody else who was responsible for the killing. The man that was responsible for the killing of 32,000 people over the last 2 weeks, he was in charge of the killing of protesters. It's an evil group. I mean, they've killed much more than 32,000 people. And the man who was responsible for that was also killed yesterday. And all of the NATO allies agreed with us, but they don't want to, despite the fact that we help them so much. We have thousands of soldiers in different countries all over the world, and they don't want to help us, which is amazing. I mean, amazing. And I didn't do a full court press because I think if I did, they probably would be. But we don't need help. That war has been long prosecuted, as far as I'm concerned, almost from day one. We knocked out many of these things. We knocked out the Navy essentially in a couple of days. Nice to see that NATO, while they agree that it was a very important thing to do, they agree fully. Nobody said, "Oh, you shouldn't do it." They would have had a nuclear weapon within 1 month of when we had the B-2 bombers bomb the nuclear potential. I call it the nuclear dust. So I think NATO's making a very foolish mistake, and I've long said that I wonder whether or not NATO would ever be there for us. So this was a great test because we don't need them, but they should have been there. The other thing is, and I think very important, we didn't have to be there for Ukraine. Biden chose to spend hundreds of billions of dollars on Ukraine, and I guess the head of Germany just made a statement that, well, they weren't involved and they have nothing to do with the war, but at the same time, they think we did a great thing by knocking them out. Nobody wants to have Iran, or anybody, but nobody wants to have Iran with a nuclear, because these people are crazy. They're absolutely crazy, and they're vicious, violent. I mean, they kill. Think of it. They killed, now I hear it's about 41,000 people. They put out a notice 2 days ago. Anybody that protests will be immediately shot and killed. That's pretty tough stuff. So everyone agrees with us, but they don't want to help. And we as the United States have to remember that, because we think it's pretty shocking.
President Macron has just said in the last hour that he will never join a task force in the Strait of Hormuz until hostilities finish. Yet yesterday you said...
Who said that? Who said?
President Macron of France. What's your reaction to that, sir?
Well, he'll be out of office very soon, so we'll have to see. I don't know.
On Doonbeg, you're building an extension to it at the moment, but there's been an objection put in, and it's being held back at the moment due to small snails. What are you disappointed about that?
No, the planning commission is.
I have not heard that. No.
Mr.
President. I mean, the course was built and it's been operated very successfully. Somebody's objecting. Human and environmental group is objecting to.
Mr. President. How closely is to announce a coalition of willing to secure the Strait of Hormuz? Which countries are joining and which countries have...
Well, we've had great support from the Middle East. Qatar has been great. UAE has been great. Saudi Arabia has been terrific. Bahrain has been very good. The Middle Eastern countries have been very strong in their support. And of course, Israel has been our partner. Israel's been very, very strong, along with our operation. I was against Iran long before I even thought about Israel being against Iran. If you look back, Many years ago, I talked about Iran was a big threat to this country, to this world of ours, and turned out to be I was right. In fact, I said you have to attack Karg Island. You have to attack them years ago when they were acting up. They've been acting up for 37, 47, I guess now 48 years. For 48 years, they've been bad players, vicious players, and you can't let them have a nuclear weapon. If they got a nuclear weapon, I would say they would have used it within 24 hours after having it. And they would have had it if we didn't bomb them out from that great raid with the B-2 bombers 8 months ago or so. You would have had a nuclear war in the Middle East and maybe beyond. I think it would have hit Europe. Maybe not Ireland, but it would have hit Europe. I think you would have been a nice piece of it. It all gets you. It's big enough that you would have been affected. They would have hit Europe eventually.
Mr. President, your Director of National Counterterrorism, Joe Kent, he just resigned today. He said he can't support your conflict with Iran. What's your reaction to that? And did you?
Well, I read his statement. I always thought he was a nice guy, but I always thought he was weak on security, very weak on security. I didn't know him well, but I thought he seemed like a pretty nice guy. But when I read his statement, I realized that it's a good thing that he's out, because he said that Iran was not a threat. Iran was a threat. Every country realized what a threat Iran was. The question is whether or not they wanted to do something about it. And many people, many of the greatest military scholars are saying for years that presidents should have taken out Iran because they wanted a nuclear weapon. They were, if we didn't do the attack, or if, I'll go a step further, if I didn't terminate the Iran nuclear deal given to us, one of the worst deals ever made by Barack Hussein Obama. Remember when they sent Boeing 757s over there, loaded with cash, hundreds of millions of dollars? You would have been very happy. This was a wonderful, they sent hundreds of millions. People forget that. Does anybody remember? Right? You remember. Hundreds of millions of dollars in a Boeing 757. I think there are two of them loaded. They took the seats out and they put cash. And it was so much that there wasn't a bank in Virginia, Maryland, or D.C. that had any money left. They stripped them of all their money, put it into place, sent it to Iran, almost as ransom. That's not going to happen with Trump. And nobody ever did anything about it. Nobody ever said anything about it. Can you imagine if I did that? So they've been a threat for a long time, but they've really been a threat. If I didn't terminate Obama's horrible deal that he made, the Iran nuclear deal, you would have had a nuclear war 4 years ago. You would have had nuclear holocaust, and you would have had it again if we didn't bomb the site. So when somebody is working with us that says they didn't think Iran was a threat, we don't want those people, because, and there are some people, I guess I would say that, but they're not smart people or they're not savvy people. Iran was a tremendous threat. And virtually every NATO nation, and this is the thing, if they told me it wasn't a threat, and therefore they don't want to help, but when they say it was a threat, and it was a major threat, every one of them, I think every one of them, I don't know of one that said they're not a threat, but when they say it was a threat, but we're not going to help, I think they're very foolish. You know, it's interesting. It's interesting because I could say this, that what's happening in Ukraine, we're probably in there for $400 billion. We don't spend any money anymore. They buy it from us and they pay full price. But Biden gave them between $350 and $400 billion of equipment and cash. Someday they'll have to find out about the cash. And you could say that wasn't a threat, you know, we're helping them. So we helped them, and they didn't help us, and I think that's a very bad thing for NATO.
Mr. President. Are there any repercussions for NATO, and are you still going to China?
Well, yeah, on China, it's a little different story. We're resetting the meeting, and it looks like it'll take place in about 5 weeks. We're working with China. They were fine with it. We're going to say, I look forward to seeing President Xi. He looks forward to seeing me, I think. But I do look forward to seeing him. We have a good relationship with China. China actually has become economically for us very good. very good, as you know. It's much different than it was in the past. And we have a very good working relationship with China. So we're making it in about 5 or 6 weeks.
Mr. President.
NATO for not supporting you on this. Any repercussions?
Well, no, I just think that it's not good for a partnership when they say what you're doing is a great thing, but we're not going to help. You know, they say what you did is a great thing, but we're not going to help.
In Iran, because the Iranian regime is told Sky News, if you put boots on the ground in Iran, it will be another Vietnam. Are you afraid of that?
No, I'm not afraid of. I'm really not afraid of anything.
Mr. President, are you rethinking the United States' relationship with NATO possibly getting out?
Well, I'm disappointed in NATO that we spend trillions of dollars on NATO. Think of it, trillions over the years, many trillions of dollars. It's one of the reasons we have deficits and we help other countries. And when they don't help us, I mean, it's certainly something that we should think about. I don't need Congress for that decision. As you probably know, I can make that decision myself. I'd work with some very smart people. And I'd always deal with Congress anyway, but I don't need Congress for that decision. But, you know, when you say rethink, I have nothing currently in mind, but I will say that I'm not exactly thrilled when we help them with Ukraine. Look, Ukraine would have been over in one day if we didn't help. Frankly, Ukraine would have been over in the first day. They had the best equipment in the world. It was our equipment, given by Sleepy Joe Biden. No charge, no charge. Hundreds of billions of dollars of the best equipment in the world, no charge. I will say that I'm not happy about it.
Mr. President.
How's your relationship with the questions, one on Iran and one on Cuba. Is Iran now a bigger foreign policy priority for you than China? And on Cuba, the Cuban government.
Iran is just a military operation to me. Iran is something that was essentially largely over in 2 or 3 days because the Navy was wiped out almost immediately. The Air Force came next. The anti-aircraft came next. I mean, we're flying over Iran. We could take out their electric capacity in 1 hour. We have all the, there's nothing they can do right now because everything is knocked out. They have no, again, no radar, no anti-aircraft. They have nothing. And we don't, and it was a decision I made. We discussed it, Pete, Marco, JD, all of us, Chris, we discussed it. We can knock out their electricity in a matter of minutes if we wanted to. There's nothing they can do about it. We can knock out their oil in Carg Island. The only thing we didn't take down was their oil because if we knock out, I call them the pipes, very complex. But if you do that, it'll take them forever to rebuild, meaning whoever, and hopefully it's a sane group of people, but whoever it is, it's going to be running that, and we're going to try to get people that are going to run it well, and you know it's going to be a prosperous, wonderful place. It used to be, you know, if you go back, it used to be the people are great, the people are smart and energetic, and it used to be very successful. Now it's a country run by fear. It's a country where they tell protesters, don't go outside because if you do, we're going to kill you.
Mr. President.
Well, Cuba right now is in very bad shape. They're talking to Marco, and we'll be doing something with Cuba very soon. We're really focused on this, but we're dealing with Cuba. Marco, do you want to say a couple of words about it?
Yeah, I mean, Cuba has an economy that doesn't work and a political and governmental system they can't fix. Yesterday's not dramatic enough. It's not going to fix it. So they've got some big decisions to make over there.
But Secretary Rubio, do you support, and I know this is up to Congress, but do you support easing the trade embargo if you get more cooperation from the vendors?
Well, I'm not going to discuss what we would talk about or not. Suffice it to say that the embargo is tied to political change on the island. The embargo is codified. And, but the bottom line is their economy doesn't work. It's a non-functional economy. It's an economy that has survived. That revolution, it's not even a revolution, that thing they have, has survived on subsidies from the Soviet Union and now from Venezuela. They don't get subsidies anymore, so they're in a lot of trouble. And the people in charge, they don't know how to fix it. So they have to get new people in charge. That's what.
And the relationship we have with Venezuela has been, I think you could almost say, incredible. It's been really good. It's been good for Venezuela, and it's been good for us. And I congratulate the Venezuelan baseball team because that was a big win. And I guess they play another game tonight in the finals. Lately, this is the first time they've ever been in the finals, and it was pretty exciting. Yes.
Iran is just a military operation to you. Do you not have a day after plan? And if so, what is your day after plan for Iran?
Well, we have a lot. Look, if we left right now, it would take 10 years for them to rebuild. But we're not ready to leave yet. But we'll be leaving in the near future. We'll be leaving in pretty much the very near future. But right now, they've been decimated from every standpoint. And again, we've had great support from countries in the Middle East, great support. But we've had no support from, essentially, no support from NATO.
Mr. President, what about your relationship with London? Has it been damaged by the fact that Keir Starmer isn't supporting you in this war? And has your opinion of Keir Starmer changed because of this?
Well, he hasn't been supported. No, they make a lot of money on trade with the United States. I went out of my way, as you know, they couldn't make a deal with Biden because they had no real administration to make a deal, Biden. But we made a deal. We made a good deal for them, and frankly, probably wasn't appreciated. I do look forward to seeing the King. He's going to be coming, as you know, very shortly. But no, I was disappointed because Keir was willing to send 2 aircraft carriers after we won, because essentially there's no threat for the aircraft carriers right now. And I said, no, we want things sent before the war, not after the war is won. So, yeah, I'm disappointed with Keir. I like him. I think he's a nice man, but I'm disappointed.
Do you have Mr. President.
You see that man right there? You know who that is?
Churchill.
Winston Churchill. The late, great Winston Churchill. And Barack Hussein Obama did not want his bust in this office. Did you know that? And Barack Hussein Obama sent that bust back to England. They didn't want it. And when I came in, I was asked if I wanted it. I said, absolutely, I want it. And I put it right there, Winston Churchill. And, you know, unfortunately, Keir is not Winston Churchill.
Mr.
No, hold it. Right.
Just could I hold it? Just make a number of points. First of all, I think, notwithstanding what has happened, the transatlantic relationship between Europe and the US is very, very important on a number of fronts. And I think we've had issues over the last year or two, but we settled them. And I think many of these leaders engage with you, particularly on trade initially. Remember all the fuss last year, but we got a landing zone between Europe and the US, and I think we can get a landing zone again. And I think I just met with Keir Starmer last week. The British-Irish relationship was a very important one. Churchill was a great wartime leader, although in Ireland there was kind of a different perspective in terms of during our own War of Independence and so on. He created his own bit of difficulties for us, but that said, he was a great wartime hero. Keir Starmer has done a lot to reset the Irish-British relationship. I just want to put that on the record. But I do believe that he's a very earnest, sound person who I think you have a capacity to get on with. You've got on with him before, and you've got on with other European leaders as well. Sure. And I think you have that capacity again. And I think everyone exists. I mean, you cannot have a rogue state with a nuclear weapon or the capacity for a nuclear weapon. Iran was a sponsor of terrorism. We sanctioned Iran. All European countries did, as a and the IRGC in particular, it's a terrorist organization. They sponsored Hamas. They sponsored Hezbollah. The Houthis. They created mayhem, a most maligned force in the Middle East. The Irish position has always been, ultimately, can we resolve this can we get peace? And obviously there's preconditions before you get to that situation. We had our own conflict, which went on for 30 years, and we learned a lot from that in terms of how to try and bring about peace. And I think I've listened to you in terms of, you're correct, I mean, our hearts go to the Iranian people who have been repressed and suppressed for so many years, culminating in that savage murder of thousands and thousands of Iranians some months ago. No one was in a position to do anything about that. I think, and likewise with Ukraine, I mean, the Russians did invade Ukraine, have attacked civilian infrastructure and so on like that. And for the people of Ukraine who just want peace and an opportunity to live, I think we have to continue to work to see, can we bring peace, different regime to Iran, where Iranians can live in peace again, and the people in the Middle East can live in peace, and you're doing your bit there in terms of the work in Gaza and so on like that. And I think that's what we want, is a peaceful resolution of conflict. That's where we come from as a small nation. Right. We've been peacekeepers all our lives, and we're the longest serving nation in terms of provision of peacekeeping forces in the world, as it turns out. But we think ultimately all conflicts come to an end, and I think we have to try and work towards that end. And I'm sure European leaders and the US administration will engage, and hopefully we can get a landing zone somewhere.
I mean, the only thing, and I agree with everything you said, but we helped with Ukraine.
Yes.
And they don't help with Iran. And they all acknowledge that Iran can't have a nuclear weapon. You yourself say, these are horrendous people. These are the worst people, and going back to Hitler, right? Going back to Hitler, these are the worst people. That's a long time ago, and there's been nothing close. Every problem, so many deaths, 90% of the people that got blown up by landmines, they loved them. Soleimani, we killed him. If we didn't, it might be a different story, because he was a horrible person, but he was a very powerful person and leader, smart. But we killed him. If we didn't, I think you'd have it. I did. But I think it would have maybe a different situation. It wouldn't have been so easy as it has been, because it has been very easy. It's all of their military is there, but you can always have somebody drop a mine in the water. It's like terrorism.
Yep.
And then you have the people that own the billion-dollar ship saying, well, let's not move that ship yet because we want. So we thought that Europe would help that, because they do have some minesweepers. But it's amazing that, they all said, what a great job. They would call me congratulating us on the great job we did with respect to Iran, and we knocked the hell out of them. They're no longer the bully of the Middle East. They were known as the bully of the Middle East, and they're not the bully anymore. But you would have thought they would have said, we'd love to send a couple of minesweepers. It's not a big deal. It doesn't cost very much money. But they didn't do that. So, I think it's very unfair to the United States. Not to me, but to the United States. Go ahead, please.
Keir Starmer isn't making...
She's a fantastic reporter, by the way. Go ahead.
Thank you. The Prime Minister isn't making the case to the British public as to why he should be supporting you. Could you do that now and talk to the UK and to GB News viewers about why it's in their interest that we help you?
Well, because we have a tremendous long-term relationship with the UK. I mean, people would say it's the best. I don't want to get into that, but we've had, it was the longest, the oldest, should be the best. Always was the best until Keir came along, and I like him. He's a nice man. He says everything beautiful. He's a very nice man with a beautiful family. Everything's perfect, but he doesn't produce. And I think it's very inexpensive. I just said, you don't have to send me aircraft carriers. Send me a couple of minesweepers. We don't need your aircraft carriers. But even the aircraft carriers, he would only send them after we essentially won. I mean, he's sending them when there are no planes left. When the missiles are down to 8%, they have like 8% of the missiles. The rest we demolish the missiles, and the factories, largely the factories are going even as we speak. They just hit another factory. They have a lot of missile factories. They have a lot of drone factories, and so he's wants to send them when we don't need them. But would like to have minesweepers, because just in case. We don't know that there are any mines down, because we wiped out, I think, 24. They actually have, think of this for a country. They have 24 boats that do nothing but put mines in the water. This doesn't sound like a great country. This doesn't sound like a friendly country, but we killed all of those boats. They're at the bottom of the sea. So we don't even know if there are any mines there, but if there are, we'd like to have a little help in finding them, probably most importantly.
Would you like to change your Prime Minister? Do you have confidence in Keir Starmer? Would you prefer to deal with...
Well, it's not for me. It's really for the people of the UK to have confidence.
Of course, but is he
I've been very critical of Keir, and I did it in a friendly way. I said, if you don't change your energy thing and get away from windmills and go back to oil and gas, and you have something that's no other country has. Very few countries have anything like it, the North Sea. You have some of the greatest oil and oil deposits in the entire world, the North Sea. They don't use it. You buy a lot of your oil from Norway. You know where they get their oil? From the North Sea. And you pay a... And I tell them, and you have the better part of the North Sea. So why aren't they taking the oil from the North Sea? Why are they buying oil from Norway? But they have windmills all over the country, destroying those gorgeous Scottish fields and those beautiful fields all over the windmills, which don't work. They're tremendously expensive. And the best testament to that is the windmills are made in China, but China doesn't use them. You know what China uses? Coal. They're building 58 coal-fired plants right now, and that's up to them. But these foolish countries that are buying windmills, putting them out of business, I'm proudly telling you that we're going to try and have no windmills built in the United States during my... They're very bad. They're very bad environmentally. They kill the birds. They're unsightly. They make a lot of noise. And for some reason, the environmentalists love windmills, okay?
You say he's a very nice man.
I think he's a nice man. I think he's a nice man, but I disagree with him on two things, primarily. His immigration policy is a disaster, and his energy policy is a disaster. And they're about the biggest policies you can have. You've allowed millions and millions and millions of people to come into your country that shouldn't be there. And by the way, that's all over Europe. Europe is a different place. It's a different place. And you know, I originate, to put it nicely, many of us do, from Europe. I love Europe. I've spent a lot of time in Europe. It's a different place. Bad things have happened to Europe. Very bad things. And you better do something about immigration, and you better do something about energy, or you won't have a Europe.
What's your time frame, Mr. President, for when cargo ships can safely go through the Strait?
It won't be, I don't believe, too long. We're knocking the hell out of the coast. It's basically the coast and the water, and it won't be too long. And the Middle Eastern states, including Israel, by the way, who has been terrific, the Middle Eastern states have been helping us a lot.
Mr. President, on fuel prices, what do you have to say to the people in Ireland who are paying sky-high prices because of your war in Iran?
Well, I think the people in Ireland are very happy that I'm getting rid of, I have a lot of friends from Ireland, they're very happy that I'm getting rid of a nuclear power, a nuclear terrorist. And as soon as that war's over, which will be soon, your prices are going to drop like a rock. You watch. I've been very good at predicting. In the back.
What do you think about our president's comments that Iran is breaking international law? What do you think about our president's comments?
Can you speak? You're speaking right into your phone.
Mr. President, how do you respond to the Iraqi militia groups against the U.S. Embassy and consulate in the Kurdistan region?
You want to answer that?
Yeah.
You want to?
Yeah. Marco, obviously, the Secretary of State has control over the embassy. Look, there have been a lot of militia attacks against our base or our embassy in Iran. I think Marco's done a good job of limiting the number of people who are at that embassy so we can provide essential functions but also protect our people. But it goes to show there are a lot of terrorists in that region of the world, and we've got to eliminate them when we find them.
And you can't give them nuclear weapons. You can give them rifles, you can give them guns, you can't give them nuclear weapons. I think we agree very strongly on that. Yes, excuse me.
Just first of all, I would say that Europe is still a very good place to live in.
Good.
Just to let you know.
I'm glad to hear that.
And our view is you have to have robust and fair rules around migration. But on the other hand, a lot of people, within the European Union, we have free mobility of people. And in Ireland, our population is growing, but in a very positive way. Our economy is going well because we're attracting a lot of people from Europe and beyond into work. legally and validly in our country. In fact, I'd love if we could develop a legal pathway between the US and Ireland into the future because of our history and so on like that, that we could have a legal pathway, because no one is in favour of illegal migration or and so forth. So you have to have robust rules for that. But fundamentally, I think sometimes Europe gets characterised wrongly in terms of it being overrun or whatever like that. It's much more robust now. It's much more stronger mechanism in place to facilitate legal migration. I think it's important that understanding is there. We need more economic growth in Europe. It doesn't have the same focus on innovation as you do here in the US. We discussed that earlier with the Vice President in terms of technology, in terms of AI. We need to pivot more to innovation as opposed to regulation. I think investing in people, and that's the key to, I think, our collective future. But we do take there and listen.
Mr. President, the Irish President has said that your war against Iran is illegal. It's an attack on international law.
Who said that?
The Irish President.
Look, he's lucky I exist. That's all I can say. Because if you're going to allow countries that are sick and demented, and they are demented, to have nuclear weapons, everybody in the whole world should be very thankful. And I'm disappointed in NATO, very disappointed. I'm disappointed in a couple of other countries too. But they should be very thankful that this group of people feels the way we do. Because if a country like Iran was allowed to have the power of a nuclear weapon, if we didn't stop them, I stopped them twice. I stopped them my first term when I terminated the Iran nuclear deal, which was Barack Obama's deal. It was maybe the worst deal I've ever seen. It gave everything to Iran, including billions of dollars in green cash. I don't mean cash, I mean green cash flown over by airplanes. I can't to this day believe that was allowed to happen. And come to think of it, it would be a good thing for somebody to look at. Does the president have the power to hand hundreds of millions of dollars of cash to terrorists? But it began with that, and I terminated that deal. If I didn't terminate that deal, we might not be here right now. If I didn't terminate that deal, unbelievable nuclear holocaust would have taken place. And then I did it a second time when we hit them with the B-2 bombers, and we totally obliterated their potential nuclear weapon that they would have had in less than 1 month. They think 2 weeks, but in less than 1 month. And it would have been, I believe it would have been a much different world than it is right now. We have to go. We're going to a lunch, so maybe we'll take one more nice question.
Can I ask you how you're doing with your legal case against the BBC and their fake news documentary?
Well, the BBC was incredible. What they did is they had me speaking something I never said. And I've never seen anything quite like it. You know, CBS had that. We had the situation on 60 Minutes, and not the current owners, the past owners. The current owners, I think, are good, Ellison. But BBC took it a step further. They actually they put words in my mouth, and I said some pretty bad things. And I didn't say them. It was AI generated. And I said, I never said that. In fact, some of my people said, wow, that was pretty bad stuff you said. I said, what did I say? You know, I'm pretty good at this stuff. I mean, if you can go through years of these press conferences and you're a popular president of the United States that won in a landslide, that won all 7 swing states, that got record numbers of votes, I mean, so I guess I'm okay at this stuff. I said, I never said that. And then we found out it was AI generated. And they admit they made a mistake. BBC. But I watched them this morning for some crazy reason, and it was so inaccurate. Their reporting on the war was unbelievable. We have decimated that country. And if you watch BBC, it's almost like they're fighting us to a draw. They're not fighting us to a draw. It was very inaccurate news. It was fake news. So I'm very proud of the term fake news because it was my term, I came up with it, but it's no longer accurate. It really is, it's corrupt, fraudulent news. It really is, it's fraudulent. It's not just fake, it's beyond fake. It's really criminal what they do. But I watched BBC this morning, and I don't know much about BBC other than what what took place, because people were calling me saying, that was a terrible thing you said. I said, what did I say? And I said, I never said that. And we checked it. Do you agree? They agree.
You've been listening to President Trump at an event at the White House with the Irish Prime Minister. He's been addressing the reluctance of NATO allies to participate in security operations in the Persian Gulf, says U.S. and Israel can finish the job in Iran without him. Also, a little bit of news, perhaps. He says that the meeting between him and President Xi of China will occur a bit later than anticipated. 5 to 6 weeks is what he said. Welcome to Halftime Report. I'm Mike Santoli in today for Scott Wapner. With me for the hour, Joe Terranova, Stephanie Link, Brian Belsky, and Josh Brown. Let's get a quick check on the markets. Had an attempt to follow through on yesterday's bounce. The S&P 500 up about 1/3%. It was at its highs about twice as much of a gain. The Dow is up 111 points. Crude, you see it there, 94.55. It's up 1%. It's been above 95 when the S&P was at its low. It's been below 94, so that's been the game continuing there. So let's just talk about this bounce attempt, I guess we could call it, Joe. It's understandable to me why it has begun entering this week in a logical spot, which is a 5% decline in the S&P 500. We got to almost to the 200-day moving average. Seasonal factors start to turn better in the second half of March. And, of course, you have this residual hope there that we've reached the point of maximum uncertainty in Iran. Maybe oil has seen its highs. Still something to prove, I would argue, though, for the rally itself. What are you looking at?
Well, I think what's most important right now is that we break the correlation between higher oil prices and lower equity prices. And the appearance over the last several days is that, in fact, we're doing so. I also believe that we've established where that breaking point for equities is as it relates to oil. So the equity market does not like oil prices above $100, above $105. That seems as though to be the breaking point. It appears as though the equity market is comfortable, as it was in 2011, 2012, and 2013, when the average price of oil in each one of those 3 years was $95. The market was comfortable in that environment with oil. So I think if we just basically elevate the range of oil to 85 towards 100, I think we could live in that world. It's when oil spikes well beyond that the markets don't like it.
Steph, I mean, arguably in the early 2010s, the S&P was at 13, 14 times earnings. Maybe not as much was expected out of stocks. But how are you reading what the market's done this week, where it's tried to find a little bit of a foothold? Because you actually have seen some of the laggard groups, try to make a little progress this week.
Yeah, and that's exactly where I want to go. Actually, value outperforming growth today and yesterday. Banks actually finally catching somewhat of a bid. We have to watch that, but they've been a laggard and something that we all have been watching because of the private credit concerns. Energy, oil stocks, some industrials are doing well. So it's more of the cyclical story today and some part of yesterday. And I think, Mike, that's because in the face of uncertainties about war and the timing, the economy is holding up. I mean, you got the Atlanta Fed tracker at 2.7%. Weekly jobless claims last week were really good. I expect them to continue to be very low in the 215 range to 220. Retail sales, core was up 4%. ISMs, 2 months in a row, over 50. So that's the first time that's happened in 3 years. And industrial production now up for the 4th consecutive month. So in the face of all this, the economy is hanging in. A lot of it is AI driven, and that's a nice tailwind, and that's going to continue. But the consumer also is doing their part. Yes, it's K-shaped, but they're doing their part. When you listen to Bank of America, when you listen to MasterCard, when you listen to Visa, last week they were at conferences, every one of them said the consumer is doing just fine. And that's a big part of our economy, so I keep a close eye on it. But I like that, at least the follow through on the cyclicals based on the data that we're seeing.
I guess the question is going to be, Josh, whether that good, encouraging evidence is going to run up against the potential that we have more friction in the story when it comes to what oil prices are doing, some consumer confidence issues, since we're 2+ weeks into this Iran campaign. I do want to get your take, though, Josh, on the general setup here, because it's hilarious how we always talk about the S&P 500 in one of these sideways phases and say, look how resilient, it's rotating away from danger. I've said it a million times. And then we get to a point when the decline starts to wear on the index, and everyone says, oh, but we haven't seen the flush. It's been too resilient. We need to see people give up on this and to create some kind of a slingshot effect. So where are you looking for evidence that the market either has the makings of that kind of a comeback, Josh, or, we're still waiting?
I think the modern investor is just different from what a lot of us are used to. Mike, you're a veteran of the markets like I am, so is Stephanie, so is Joe, but we have to acknowledge the fact that today's investor, they sort of get it like, oh, if I sell when the S&P falls 5%, I'm going to look like an imbecile in like 3 weeks, so I'm not going to do it. And instead, what we're seeing is, I'm going to use the word rotation for the millionth time, but I think it's the most important concept. Investors are flocking to the stocks that are going up right now. And, look, the best stocks in the market concept is, where is the real strength? And think about the stocks that Joe has been talking about, I've been talking about, Stephanie, Chevron, Exxon, making record highs today. Look at the refiner complex, Marathon, Phillips 66, and of course Valero. And even like the oil services names, those did get hit a little bit harder during the Iran episode, but they're all right back. Baker Hughes, right back. These things are in substantial uptrends. So I think investors are like, all right, I get it. We're not playing the software game this year. We're not playing the data center game as much this year, maybe in the industrials, but not in the actual Mag 7 stocks. But this game, this is a great game. And you're seeing it everywhere. And you can't tell me that's just retail. I know the pros are doing it too. The other thing is, the only real panic that we're seeing, it's actually funny, it's in the private market. How do you panic in the private market? It's like a mime. Like, how do I get out of this invisible box? It doesn't even show up in the junk bond ETFs. So yeah, we have concerns. Yes, there are issues in the market, there are question marks, but I think the modern investor, at least for now, has done a great job rotating, moving to where the money is going, and ignoring the things that historically would have put them on the sidelines, even 3 and 5 years ago, and they just don't race to the sidelines.
I mean, did we have a modern investor 11 months ago, Josh, when everybody was liquidating everything at the lows?
I don't know that everybody did that. If you look at Vanguard data,
you can look at the flows.
If you look at Vanguard data, Charles Schwab data, you look at Fidelity data, 401k flows never stopped, and that's the real money. So seeing $20 billion come out of an SPY and then go right back in 2 months later, I don't really think is what the main body of investors are doing. Look at the 401k flows. They never budged, nobody sold, and I don't think they'll do it this time either.
We magically got 20% down with nobody selling, I guess. Okay, in a flash. Brian, what are you thinking about in terms of field position for the market here? And I'm looking at an S&P. We're at the December lows. Yes, we're up off of last week's bottom, but it doesn't seem as if there's a sort of a tentative nature to this comeback. And maybe that's to be expected because there's a pretty wide range of outcomes we're having to entertain here.
No, I think that's right. But I also think, too, to double back on what Josh was saying, take it from a guy that's been doing this since the late 80s. We were always looking for the big flush. The big flush rarely happens. And then people typically, especially in this market, don't get in fast enough. I think that's right in terms of the moves that we've seen so far. But I think what the market's saying is kind of what we teed up when we talked about our year ahead piece for 2026, when we talked about the market is clearly transitioning from a multiple expansion market to an earnings driven market. Stephanie talks about earnings all the time, and we always talk about resilient. But from a sector by sector basis, the quality of earnings in 2026 is very good. The consistency of earnings growth is very good. I think we tend to make too much out of trying to catch the bottom in some of these themes, quite frankly, Mike, with respect to software and trying to catch the falling anvil, as I learned a long time ago, that old saying. But I do think what's happening today is a very constructive day, especially considering the broadening out across board. Small cap stocks are working. Stephanie talked about financials. We think financials from an earnings perspective are really going to be driving things the second half of the year. And we actually continue to believe both institutional and private wealth clients are way underexposed financials, and we really think that's an area where we're going to see a lot of gains.
Yeah, I'm not so sure about that, Brian. I think financials were the favorite sector coming in to 2026. All of the
I don't agree with that.
funds.
The favorite sector? No way was it the favorite sector. Everyone was trying to play healthcare because healthcare in the fourth quarter, Joe, was the momentum play. I think financials actually were outperforming well before the fourth quarter. Everyone was trying to think more value side of things. And yeah, well, industrial, if you go back and look at some of the tape and on this show in particular, everyone was trying to chase energy, healthcare, utilities, consumer staples. They were much more defensively positioned. Financials, I think, at the end of the day, though I will say the money center banks, but no, everyone's missed the move in the small cap financials, which has been actually quite good. So I don't agree with everyone was loving financials
We're just
at all.
going to disagree. It'd be better if you were here and we could disagree in person. But if you look at a lot of the momentum funds at the end of 2025, they were all significantly overweight. I run one of them, financials. You had a lot of people that were coming on the shows and talking about financials being the best place to be, banks themselves. And I think fundamentally a lot of those conditions are still in place, but you are seeing a recalibration as in terms of sentiment and positioning for that sector itself. I do agree with you on where we were at the end of 2025, where the market did its job in getting in front of the flush in software, the flush in the private equity names, and really pivoting towards the healthcare names, the defensive names, the material names, the REITs that so far have exhibited a strong degree of resiliency.
Guys, we want to get further into this financials issue. Actually, alternative asset managers, they are rebounding today, but private credit concerns, of course, continue to weigh on the space. New data shows it's another issue on the minds of respondents to the latest CNBC Fed survey. Senior economics reporter Steve Leisman joins us with more on all that. Hey, Steve.
Hey, Mike. Yeah, the war in Iran is top mind for respondents to the CNBC Fed survey, but there is concern about a more far-reaching impact from a downturn in the private credit market. Take a look at some of the data here. Yesterday's close 66.99. This is on the outlook for the S&P. Now that's come down to 70.16, but they also are pretty optimistic about a rebound from that lower number from 2026, going to 76.27 in 2027. That is. But asked about private credit worries, 66% say they're somewhat concerned it could reduce economic growth. 69%, and this is the one that may matter if it does, that it would create broader systemic risk. In fact, our gauge of systemic risk that we have, 75% now saying it's somewhat elevated. That's the highest we've seen since starting to ask this question about credit markets back a couple years ago. And you can see here, it's not the top issue. Tied for number one, higher oil prices in terms of threats to the economy and the war in the Middle East, continued high inflation, policy uncertainty, and global economic weakness, which is something to think about in terms of what happens overseas to the economies from oil prices ricocheting back on the U.S. So private credit concern, not a leading one, but something being watched closely for whether there are broader implications for the U.S. economy, Mike.
Steve, thanks so much. Josh, love for you to weigh in on this. I mean, 2/3 of these respondents are saying that this could be systemic when it maybe otherwise can be characterized as just a little bit of a mismatch between liquidity expectations among certain investors.
Yeah, look, I think if you pull those 5 graphics off the board and 6 months goes by, we'll have 5 new ones that we can replace them with. And these concerns are, some of them are evergreen. Like you could throw up like budget deficit. I mean, it's actually very healthy that we've had multiple compression and a lot of things to worry about in the market this year. It's actually a better setup for people putting dollars to work today than when we're in these moments where everything just seems like it's going to be absolutely perfect. So this stuff is obviously food for thought, worth talking about. The reality for me, though, I'm not one of these Wall Street guys. Don't let this shirt and tie fool you. I am a man of the people. My text messages are filled with regular investors, people I know in real life, guys that install alarm systems, insurance salesmen, car dealers. You know what they do when the market's down 5% because oil's spiking, or when Trump says something out of pocket about tariffs? The first text to me is, all right, what should I buy? Until that flips, and it might, but until that mentality flips, I remain steadfast in what I was saying earlier. I think the investor class has gotten a little bit smarter, a little bit more self-aware before they panic. Would another 10% down change people's attitudes? Yeah, of course. But that's not the situation that we're in. So, you know, that's the way I think you want to think about the market setup today.
No, I'm with you on that in general, because 5% down doesn't necessarily mean everybody should be screaming and running away. In fact, we had a 5% pullback, Steph, in November, and I don't think on any of these metrics you saw the panic in the numbers, and we did recover it. So it wasn't exactly like, you know, a new bull market launching, but it was recovery back to new highs. So I guess that's just one way to contextualize all this. Just quickly on the financials, though, I do wonder if you're concerned that they haven't been able to make much of great earnings, you know, obviously for the fourth quarter. The idea that they have this nice regulatory runway, they're going to get capital relief, and that they're kind of this sort of little bit of a problem child when you look at the leadership.
First and foremost, if we wait for certainty, Mike, you're going to miss a big, big move, right? I mean, if you sold on Liberation Day, you missed 35% growth for the next year. So to me, the market always climbs a wall of worry, to Josh's point, and it's whatever flavor of the month it is in terms of what we're worrying about. That's okay. That's why I always focus on the fundamentals, and that's why I always focus on the economy and the data points that we're getting, not only from the government data, but also from the companies. They tell you an awful lot of stuff at these conferences, and that's why I felt really good about adding to Truist last week and adding to the financials, down 10-15% on the year, because I'm not concerned about the private credit issues for them. In fact, I can make an argument that the big six banks have taken market share from the private market industry. They have not been able to do that because of the regulations. And now those regulations are starting to ease, and I think these companies, you see it in the H8 data. I mean, the H8 data, we had great numbers, 18 out of the last 21 weeks. I mean, they're talking about record highs for C&I loans. That's what we want to see from the banks, and that's what they're doing, and that's what they're telling us that they're doing. So I expect the earnings to be good, and for the stocks at these valuations, I think you got to be adding to them.
Speaking of things companies tell us at conferences, we really got to get to NVIDIA and what Jensen Huang has been saying over the last day plus, and also how the stock has reacted to it. I do just want to have his take on what he was talking about when he threw out that $1 trillion backlog number. Let's listen to his comments.
We already have high confidence visibility of $1 trillion plus of Blackwell and Rubin. Not anything else, just Blackwell and Rubin. And so, you know, we still have 21 more months of new orders coming in. We still have all of the other things that NVIDIA sells. And so I just wanted to give everybody a baseline. The ecosystem needs to know directionally where NVIDIA is going. Now, of course, we plan with a supply chain. We help everybody with their capacity building. We prepare all the technology partners so that we can support $1 trillion worth of Blackwell and Rubin. And so it's an incredible thing.
Certainly an incredible thing. We still have to figure out how we're going to frame this. Brian, this is $1 trillion seemingly in cumulative orders through the end of 2027 for those two product categories. Right now, consensus top line for NVIDIA for this fiscal year and next, it's like $830 billion. So who knows when that stuff filters into revenue? Who knows how much of an upside guide this might have been? The stock is sort of shrugging. So how are you thinking about it, Brian?
Well, I think the stock is shrugging because people have been worrying about technology. I do think that the most important thing that he talked about was the baseline. And he's being very consistent in his delivery of information. And I think that makes everybody feel better about the other areas of what's happening in terms of NVIDIA's products. So think of like NVIDIA being the core inside an Apple, and then the rest of the inside of the Apple could be an AMD, a Qualcomm, and a Broadcom. And then I think that Apple in general has been bruised because the apple fell from the tree. And so now you got to kind of eat around the bruises. But at the core, NVIDIA is proving with respect to its fundamental consistency on where this is going. So that's why it absolutely positively, in our view, has to be a tactical position in S&P 500 product or growth product for the next 12 to 24 months minimum because of what it's doing fundamentally in providing that fundamental consistency with respect to the AI trade.
Joe, NVIDIA has, it's been sideways for half a year, but it has also kept most of its outperformance relative to like the NASDAQ 100 over that period.
Yeah, I don't understand why people are so frustrated by performance. I think Brian said it elegantly when he described the environment fundamentally for NVIDIA. You know who NVIDIA ultimately is. I made the comparison yesterday to Aaron Judge. Aaron Judge may have a season where he's only going to hit 35 home runs. He's not going to hit 55 or 60 home runs. That's still a really good season. And if you look at NVIDIA's performance over the last 6 months, it's outperforming the S&P 500. It is year-to-date the best performing Mag 7. And it's delivering on all the metrics that we were told were remarkably important for this company. You can't expect the company to have an 800+ % gain over a 24-month period like it had from the end of December 2022 through 2024. You're going to see a degree of maturity. You're going to see a moderation in performance. That doesn't mean it's a bad stock. It's not at all. It's one of the best performing stocks and probably the top stock to own in the market.
Who's your incremental buyer, Joe?
Yeah,
everybody is in this thing. I'm probably the only one that's not.
Aaron Judge is entering his age 34 season. The world knows he's going to decline.
You've got 94% of the sell side that have buys on this as well. So it is a very well-loved stock. If it does not go up on great data that they did present yesterday, what is it going to take?
Does that mean it's going down?
Look, I'm equally as bothered by and worried about Broadcom because it doesn't act well either, and that's gotten a lot crowded as well. I think there's so much more opportunity on the software side, especially given what we have seen in terms of the declines and now more reasonable valuations.
All right, but my counterpoint to that would be it does not extrapolate that it means it's going down. Running in place, I am not, from a risk to reward standpoint, I'm not going to move to the sidelines in the stock just because it's running in place. I think that's a foolish endeavor. I'll maintain my exposure there. I'll be thankful for the 800+% that it delivered me while I owned it for those 2-year periods. I'm not going to move to the sidelines.
It's opportunity cost. It's opportunity cost.
Right, and everybody who owns the index is maintaining their 7.7% position in it, so it's hanging around there. We have to run for just a minute. Up next, Steph has a new buy. She'll tell us all about that. Plus, we'll break down today's top movers, including a pop or Delta. Halftime. Back in 2 minutes. welcome back. Let's get to Steph's new buy. Steph, you bought ServiceNow. Looks like it's in sort of recovery mode to some degree here.
Well, I hope so.
Yeah.
I've been adding to software, Synopsys, Palo Alto. This is a new position, though, ServiceNow. I've never actually owned it. This stock is down 44% from its high. It trades at 27 times for 20% growth, 13 times EBITDA versus 39 times for its average. This is a company that has MAU growth of 25%, a retention of 98%, an excellent pipeline, and operating margin expansion. So I don't know if this is the bottom, but this is quality on sale as I have this as a definition. And they have an analyst day in May, which I think will be a nice catalyst for, just getting comfort that the growth is still there.
Brian, this has been the kind of stock that sort of faces the burden of proof that they're not going to get displaced by AI one way or another. Bill McDermott was here with me and the group on, I think last week on Friday, talking about how AI can tell you how to do things that can't actually do it for you that ServiceNow does.
I mean, this is a name, too, that we love a lot as well. I think at these levels, and Stephanie's actually doing an amazing job picking off these great names, especially if you believe that the upside is still there and the stock maybe was oversold due to this panic with respect to going on in software in general. And I do think the AI theme that everybody seems to want to believe that there's going to be less jobs. I could build you a case there are actually going to be more jobs with some of the AI situations with respect to engineers. And I don't think we don't talk enough about that on this show in terms of the software engineering help that's going to be needed to interpret some of the AI data as well.
Yeah, that's certainly, I guess, the hope. We do want to get to Delta in particular in the airlines. Up 5% today. The company did raise first quarter guidance on some strong demand trends. Joe, you do own this one. Of course, the whole group got smacked in the last couple of weeks.
So this is obviously the premium airline, and they're able to defend against rising costs, whether that's labor or now it's going to be fuel. Remember, they do have Monroe refineries, so they have the ability to access the oil at better pricing levels. I also think they benefited from a pull forward. And I think the pull forward came from the consumer recognizing smartly that prices will be much higher for those summer travel trips, and they said, let's get in front of that and book now.
Let's quickly also mention Uber, also up 5% right now, planning a robo-taxi rollout in 28 cities starting next year. Josh, game changer or no?
Yes, this is a game changer. They've just made 4 announcements in the last 5 days. One was with Wave and Nissan. Another was with Zoox, which is backed by Amazon for Los Angeles and Las Vegas. There was a third one. It probably wasn't that interesting because I already forgot. And then this, which is a really big deal. NVIDIA is going to equip all of the OEMs, every car manufacturer you could think of, with the chipset and software that will enable those cars to become autonomous. And once that happens, all of those cars via NVIDIA will be ultimately on this Uber network of autonomous options. I think they're checkmating the game. I think the narrative that's driven the stock down from 100 to 70, that like somehow they were blockbuster, I think you can laugh at that at this point. They are going to have the broadest network of partners who are offering autonomous rides on their platform, and they'll be the best at it because they always have been.
All right, Josh, thank you. We got to go for the moment, but final trades are up next. Somehow we're almost done. We're back with final trades. Josh, start us off.
Remaining long Uber.
All right, you just told us why. Excellent. Brian.
Talking the talk and walking the walk. We like the small cap banks. Pinnacle Financial.
All right, Steph.
Bank of America, 1.2 times book value, still down 14% from its highs.
And Joe?
The end of October, we bought eBay at 81. I was puzzled why we did it. Now I understand why. That's the final trade.
You were puzzled why you did
we bought
it,
yep.
not why you didn't. Excellent. All right, up 4% today. That's going to do it for halftime. I will see you at 4 on closing bell overtime. The exchange starts now with Kelly.
Thank you very much, Mike Santoli. And we're seeing stocks drift higher as per usual in the afternoon before a Fed decision. Welcome to the exchange. I'm Kelly Evans. The Dow's up 100 points at the moment. The NASDAQ, we could call it up, leading the way of the major averages of 0.4. The small caps are up 0.5%, though. The S&P is up 21 points to 6720. Now, this does come ahead of tomorrow's Fed decision, where they are expected to keep rates on hold, keeping things steady. We'll get the dots, as they're called, their projections, but traders don't seem too concerned about a hawkish outcome, at least as of the moment. Software and memory names are leading again today, as the IGV is now up more than 5% since the start of the Iran war, and the memory names continuing their climb. Western Digital up 10% in 2 days, Seagate up 7%, as SK Group says the wafer shortage could last until 2030. Oil is also rising again after Iranian attacks on Gulf energy production infrastructure, some saying that's a first for the war. Iran also hit a fuel tank at Dubai's main airport. All this has WTI up 2% to 95 a barrel, and diesel is over $5 a gallon for the first time since 2022. So let's begin with the latest developments, including a surprise resignation today from the U.S. counterterrorism director opposing the administration's war. The president himself addressing that just a short while ago. Eamon Javers has the latest. David?
Kelly, that's right. The resignation came from Joe Kent, who is the top counterterrorism official at the Director of National Intelligence Office here in Washington. He said he was opposing the Iran war, and he said he believed that Israel had pushed the U.S. government into a war that it simply can't win or doesn't have a quick way to achieve victory. The president was asked about that in the Oval Office a short time ago. He said that Joe Kent was somebody he always saw as a nice guy, but he thought he was weak on security, and he's glad that he is gone. The president, remember, yesterday in the Oval Office suggested that he had a number of countries who would send naval support to help open the Persian Gulf and the Strait of Hormuz. Today, though, he said that the NATO countries have turned down his request for naval support. Here's what he said about that.
All of the NATO allies agreed with us, but they don't want to, despite the fact that we help them so much. We have thousands of soldiers in different countries all over the world, and they don't want to help us, which is amazing. I mean, amazing. And I didn't do a full court press because I think if I did, they probably would be, but we don't need help.
Kelly, so the president's saying two things simultaneously there. One is that he's deeply disappointed with NATO countries for not helping the U.S. military. And secondly, that the U.S. military doesn't need any help. So we'll see ultimately where all this ends up, Kelly, as we wait for the president to signal what his plans are to get the Strait of Hormuz open, as obviously oil markets and world financial markets are watching that situation very carefully.
All right, for now, Eamon, thanks. We appreciate it. Eamon Javers. The market continuing its rebound from the Iran conflict today, even with oil prices on the rise. But geopolitics isn't the only story that's been rattling the market. There are also concerns around private credit and its exposure to software, which led to an exodus of investor money from private credit funds. The biggest lenders going on media tours to downplay the risks, although Apollo Global's John Zito is calling out the industry as being arrogant in a recent Wall Street Journal article. He also called out one firm in particular, Thoma Bravo. And that brings us to our first guest today. Orlando Bravo is founder and managing partner of Thoma Bravo. He joins the program alongside our very own Leslie Picker. Leslie?
Kelly, thank you very much. And Orlando, thank you for having us. We're here at your Investor Day in Miami, the largest investment firm exposed to software. So it's a really critical time to be having these conversations. And I'm just curious to just address the elephant in the room here. Are your LPs freaking out about everything that's happening with private equity and software right now?
First of all, it is so awesome, Leslie, to have you here at our annual meeting. Our LPs are relieved. You know, just in the hallway after our morning session, one of our biggest LPs comes up and says, thank you for having this conference, your annual meeting, at this time. 2 weeks ago, I'm just reading the news and reading about all these SaaS problems in the public markets. This was a great day to walk our partners through the details of our 77 companies and those fundamentals. And what they see is, for the most part, our companies are crushing it. Our companies are incredibly positioned to be winners in the agentic era, and our companies are well on their way toward becoming AI-centric companies. So I think relieved and back to fundamentals and back to the details of the companies has been very nice for them.
So do you think there's something different about the companies in your portfolio than the public markets? Because you look at just the S&P Software and Services Index, it's lost a quarter of its value since October. I mean, is this a sector issue, or is there something idiosyncratic about what you're seeing in your own portfolio here?
Well, first of all, we've been doing software investing, over 500 acquisitions over the last 25 years. We have been living in the details of the space for a very, very long time, and not at a high level, not investing in stocks, investing in companies, customer contracts, knowing the details. So yes, as a sector specialist in private equity, our companies are very, very different than public companies. Now, in the public markets, if you look at it, there are many, many software companies in the public markets that will be disrupted from AI. Those companies were going to be disrupted anyway. AI will create that disruption a lot faster. And some of the decreases in their valuations are very warranted. And we would have no interest, for example, in buying those companies. Now, there are other, and many of them out there in the public markets, where this is unjustified, where they're phenomenal businesses that are actually going to be big winners in the agentic era, and those companies have been severely punished when they shouldn't have been.
What does it mean for valuations in your own portfolio? I mentioned the S&P Software and Services Index losing a quarter of its value. Do you feel the need to mark down your own portfolio by a similar magnitude, or how are you thinking about the valuation changes given what we're seeing in the public markets right now?
It's not close to the same magnitude. Of course, we have to use public comparables to decide on the values, along with our advisory committee, on the value of our companies every quarter. But we have never marked our companies close to the public comps. I mean, we are fundamental investors that mark our companies on EBITDA, free cash flow, and net income. Those multiples in the public markets have gone from 22 times forward EBITDA to about 17 today. In general, these are still very healthy levels, and we can earn excellent returns at those exits or at those levels.
The Wall Street Journal, of course, publishing a piece yesterday, Kelly referenced it in the intro, where they quoted comments made by Apollo co-president John Zito in what was supposed to be a closed-door meeting, but he said that, quote, he literally thinks all the marks are wrong, private equity marks are wrong. Do you think there's some truth to that?
I cannot comment on other people's marks. That is not my business. I don't know the details of those companies, and I frankly don't know those marks. We have here with us literally 100% of the largest state pension plans in the US, and literally all of the sovereign wealth funds of size in the world. Many of those have been our partners for 25 years. They have seen our marks, they have seen our exits, they have seen our progression. And everybody's extremely comfortable, and we're extremely transparent as to what our companies in general are worth.
Let's talk about private credit as well, because Zito also mentioned that the recovery rates on a private credit loan to a small or mid-size, he called it a Joe software company, will be between 20 and 40 cents on the dollar. And of course, Thoma Bravo has about $25 billion through its credit platform. How are you thinking about your exposure there?
Well, we don't have the Joe software company. We don't have the middle market, horizontal company that has very little franchise value. That is where our credit platform is very special. Like you said, we have close to $200 billion under management. 25 of that is in credit. But we integrate how we invest in credit as to how we invest in private equity. That sector expertise is more critical and more important now than it's ever been. And we are so comfortable with our private credit book, given the choices we've made as a specialist in the space.
One specific example he pointed out was Medallia, a $6.4 billion take private of Thoma Bravo. how many examples like that? Do you agree with that, first of all? And then how many other examples like that are there?
Okay, I don't know exactly what he said about Medallia, but let me address that. Medallia is a fine company. The management of Medallia is doing a wonderful job. We're beginning to gain share again. Now, from an equity standpoint, as an investor in the company, in the equity, as the owner of the company, when we bought it, we way overestimated or extrapolated the very high rates of growth of that company into the future. And we made a mistake. And that cost us to pay too much. Now, the equity from our standpoint has been impaired for a long time. And our investors, this group that holds the capital in the world, has known that for years. So there is no new news. So we at times make mistakes and we own them. And I put myself in terms of that as well, because I'm part of these incredible deals with my partners. Now, the other 77 companies that we have, for the most part, and it's so relevant for AI, I promise you that they're absolutely crushing it. Dayforce, 43% growth. Jeppesen, accelerating growth, the business that we bought from Boeing. Anaplan has become an AI-centric company, accelerating growth. Coupa right behind it. Imprivata, our entire cybersecurity portfolio. So we feel so excited now about how our companies are doing today and how well they're positioned for that agentic future that's just broadened their markets. You look at some of the public companies that are very large, the good ones out there. It is very difficult to grow in software at the high double-digit rate at 10 billion, 20 billion, 30 billion of revenue. AI for those companies has opened up a whole new market that will give them runway for many years. And investors will be figuring out, based on track record, which ones are on the right side and which ones are not.
So then, there are many out there who say private credit, private equity, software exposure, all of that's going to be the next crisis. It's going to blow up. Those are, the people who are maybe, super, super concerned about this. What do you say to them and that notion? Do you think there's any logic behind it or any truth behind it? Maybe not just at Thoma Bravo, but broadly speaking across the software and private credit ecosystem.
In general, definitely not at Thoma Bravo. Once again, we're not perfect. We have made some mistakes, but that's why our investors are relieved. For the most part, we buy the highest quality software company, and we're known for running them really, really, really well. And we're solid where we are now. Now, there was a lot of excess in the business in general, private equity, private credit, and software in general since 2020, 2021. Some of the issues now in those sectors that relate to software are due to those excesses. And some of those issues are also due to the interest that generalists had in buying software companies. There are so many cases that we've seen where generalist investors that are good in general have entered the space and have bought software companies that really lack deep franchise value, even though their gross retention and net retention metrics look good. And those companies now have a bit of a more uncertain future with AI right upon us.
And you've also called out the risks of retail investors in the private markets in the past. We've seen, of course, over the last few weeks, several of these non-traded BDC companies see higher than expected redemptions, needing to gate those and so forth. What do you make of all of that, and what do you think is going to be the overall impact of the situation we're seeing right now with private wealth?
So you have always known our approach about that. We have proceeded very, very cautiously towards that market. We want to see how others do. We want to see how retail investors react to the asset class. My concern about it has been that your investor really, really needs to understand what you're doing. Were you doing the deals that you have the core competency to do? Are you investing the capital just like you told them you were going to be investing it? That's what we like about these institutions. Every year we all come together for literally 2 days where you have what other business in the world has that, where you have all your shareholders, all your investors in the details understanding it. Institutions have that with us and with other private equity firms. I think it's so important to have the retail investor really, really understand what they're investing in. And that to me has been unclear at times.
All right, Orlando Bravo, thank you so much. A very important time to hear your perspective, of course, here at your investor meeting in Miami, Florida. Really appreciate your time today.
Thank you.
Thank you. Kelly, I'll send it back to you.
Leslie in Orlando, Bravo, thank you very much. Again, as you just heard him say there, addressing the software issues with Medallia in particular, he said it's a fine company. They're doing a wonderful job. They're beginning to gain share again. We made a mistake, way over extrapolated the growth into the future. And he said our investors have known that for years, adding that one of his largest LPs was relieved and thanked him for holding their conference today to shed more light on the 77 companies in their portfolio and their fundamentals. Now, in the meantime, in the public markets, investors are still bidding stocks higher and seemingly shaking off concerns about Iran for a second session. Our next guest agrees that fundamentals are intact, but says some windows of opportunity could be closing in certain trades. Ben Snyder is the chief U.S. equity strategist at Goldman Sachs. Ben, it's good to see you. Where's the window? Only open a crack. We got to still get in before it slams shut.
Obviously, uncertainty today is very elevated, but if we look forward 6-12 months, the trajectory of earnings growth for the S&P 500 and the broader U.S. equity market still looks very healthy. I think the points you were alluding to is our recommendations coming into this year that there would be some real pockets of cyclical acceleration. We saw that from around October or November of last year through January in sectors like the consumer discretionary sector, in parts of industrials. And even though we still feel good about the economy going forward, we think we're coming to the later days of those cyclical trades in particular.
Okay, before you circle back to that, do you have sort of a larger thought about what's going on between the public and private markets, Ben? I mean, look, you're the chief equity strategist, so you cover publicly traded stocks. It'd be nice if there were more of them. A lot of them are now, they're venture capital, they're in private equity. That was a little bit of kind of undertone of Leslie's discussion there. The SEC now says maybe it's going to get rid of quarterly results. That's a seismic shift, and I'm reading analyst notes that say, yeah, they think this would come to bear in 2027.
At the same time, of course, we are talking about some very large IPOs potentially on the calendar this year. So I don't think we should be writing off the public markets just yet. If you look at the size of the markets, of course, it's hard to match or compete with the liquidity and the depth still of the U.S. public equity market.
All right, so if that is the case, and we can then not worry about market structure so much as just focus on these fundamentals, you were mentioning cyclicals, and you're on that, leading into that side of the trade?
We had been leading into that side of the trade because we saw a number of reasons to expect economic acceleration at the start of this year. That included lapping the tariff shock from this time last year. It included the tailwinds from monetary policy and the tax refunds that are being delivered now as a result of the One Big Beautiful Bill Act. That said, we always expected this acceleration to mostly be a story for the first half of 2026. Equities live in the future, and so now as we near the end of the first quarter, especially given the headwinds of geopolitical uncertainty, we think it's time to move on from many of those cyclical trades.
To move on from the cyclical trades into what exactly?
Well, so one example is that we had been recommending small caps. They performed quite well at the start of the year. We now think investors should rotate towards larger stocks. Another example is for the last several months, we've seen relatively low quality stocks outperform. That means stocks with lower profit margins, weaker balance sheets, et cetera. We now think investors should think about rotating into companies with stronger balance sheets, higher profit margins, these types of rotations in the equity market.
Is it true that the Mag 7 is down about 8% this year? I mean, is that effectively what you're saying, that get out of the cyclical trade? I don't know what that means for the economy. I want to bring Stephanie Link on to respond, but is it because you're suggesting that large cap tech is the way to go here?
I think large cap tech looks attractive. Clearly one of the highest conviction and most consistent trades this year for investors has been the AI CapEx story. We've seen an incredible upward revision to those CapEx spending forecasts, and that's been a major tailwind for the companies that are receiving revenues from that CapEx, including the memory stocks you were mentioning just a little bit earlier.
Right, but as you're saying, if that's kind of overdone here, what would you do with the financials? With, I mean, some exposure concerns to private markets for sure, but also just larger questions. Yield curve's been flattening a little bit.
I think you're right. Classically, if we don't know anything about the private markets, financials tend to be very cyclical. And part of what's happened recently is the market has doubted the economic outlook given the geopolitical conflict. But one other dynamic we've seen consistently over the last several years is the market can be very quick to price systemic risk, but it takes a while to pull that risk out of the market. We need to see continued resilience, no new blowups, et cetera. And so I think ultimately financials will be an opportunity, but I think it'll take a while to prove to the market that there isn't a major risk here.
All right, Mags, can I quote you on that? Mag 7 all the way?
Yes.
Okay, Ben, thanks. Good to see you today. Again, a very different tone than we had a couple months ago when we kicked off the year. Ben Snyder from Goldman Sachs. I appreciate, not from him, by the way, from everyone in the market. Coming up, oil prices hovering around 95 a barrel, but they're still up 40% since the Iran war broke out. What impact will the spike have on tomorrow's Fed decision? How will Fed officials think about it? We'll talk about that next. But first, airline executives meeting with Wall Street analysts in Washington, where everyone's asking about rising jet fuel costs. Citi says the carriers focused on business travel should have no issue raising fares and passing that along. We'll ask American Airlines CEO about that next.
This is The Exchange on CNBC.
Welcome back. The airline stocks are higher today. Delta in particular were pretty much around session highs with a 7% gain. The company, Delta, talking about strong demand. We also saw the raised first quarter revenue guidance, and they've been beaten up this month as jet fuel sits near 2022 highs and spending concerns crop up amid the Iran war. The carriers, of course, are also dealing with hours-long TSA security lines as this partial government shutdown persists. In fact, the CEO sent an open letter to Congress, writing in part, once again, air travel is the political football amid another government shutdown. And that, quote, it's past time for the government to make sure that TSA officers, U.S. Custom Clearance officers at airports, and air traffic controllers are paid for the job they do. Joining us now to discuss all of that in a CNBC exclusive is Robert Isom, the CEO of American Airlines, with our own Phil LeBeau. Welcome to both of you. Phil, go ahead.
Thank you, Kelly. Robert, thanks for joining us here. We're in D.C. for the J.P. Morgan Industrials Conference, where you gave a presentation earlier today, and much like Delta and other airlines, you're raising your guidance when it comes to Q1 revenue. Explain what you're seeing in terms of the market right now.
We really like what we see. Demand for our product has been strong. And so as we take a look at year over year, it's an extra $1.3 billion. We expect now for revenue growth, over 10 percentage points higher year over year. And it's really broad-based. It's every segment. It's premium, it's leisure, it's domestic, it's international. We like what we see.
There's not a weakness in any of the major segments that you're talking about, whether it's transatlantic, whether it's domestic?
Phil, we see broad-based demand, and it really is proving nice. Fare environment is fairly healthy, and I like what I see going forward. So we don't see weakness throughout the system.
Yet on the other side, on the cost side, you are being impacted by higher jet fuel costs. I mean, essentially, you've got oil that, since the beginning of the year, it's doubled in price. And when you add in the crack spread, you guys, the airlines, are certainly paying the price there. Your guidance is on the lower end, but you're not cutting guidance.
Right.
How confident are you that you can hold the line there?
Again, we're really pleased that the revenue has been such that it's offset a material increase in fuel costs. It's only been 7-8 weeks ago that we talked on first quarter, our fourth quarter earnings, and we've seen a $400 million impact to the cost of fuel. But as going forward, we really like what we see from a revenue perspective, and at American Airlines, we're ready for whatever comes our way.
Robert Kelly's got a question for you. Kelly?
Thank you both. Robert, I was just going to ask if there are any other longer-term solutions. The way that, as you said, airlines are always a political football. How do you prevent that from happening going forward? Are there privatization options? I mean, I've heard the administration might even have to shut down some airports because of what's going on right now. What are some of the bigger picture ways to try and solve this, or do they exist?
Well, first thing is our TSA workers, they deserve to be paid. They come to work every day, and they deserve, like any of us that do our jobs, to be paid. They're protecting us as travelers. They're helping the industry. And I encourage our politicians to get back to work and then just get this done. There is no reason for it, and we just don't need this distraction.
Robert, are you noticing any impact in terms of operations? Because I see the reports, everybody does. Long lines, whether it's Houston or New Orleans, Atlanta. It's not everywhere, but where it's happening, it's significant. Is it impacting operations?
So far for us, Phil, our big hubs, the TSA workers, they're coming in, and we greatly appreciate that. That said, that's not going to be the case as we go forward. We've got to get them paid. And we serve everybody throughout the country, so it doesn't matter what airport. We don't need the inconvenience, especially in a backdrop where American is delivering, in every respect, from a network perspective, customer experience perspective, offering a product that people want to have, and loyalty as well. This is not the time for us to be dealing with this type of issue.
I also want to ask you about the Wall Street Journal report that the SEC is preparing to move forward with a proposal where you don't have to do quarterly financial filings. You can do it twice a year, every 6 months. Would you like to see that happen?
Well, I know our finance team would. But we're a long cycle business, and I'd love to have a long-term view of everything that we do. But at the same time, we're dealing with a lot of noise in the system right now, and our investors, they really want a lot of insight. And you know what? We're going to do what our investors want.
So you know that there are investors who would like to hear from you more than every 6 months. They would like the mid-quarter update like you give right now.
Especially. And as American really gets back and gets full into motion, this is a time where I love telling our story. I love talking to the marketplace, our investors, about what we're doing to make sure that American really delivers for them.
And you've had a number of investor meetings today. Had probably a few more today. Robert Isom, CEO of American Airlines, joining us from here in Washington, D.C. Kelly, we'll send it back to you.
Amazing to see the resilience with everything being thrown their way. Thank you both. Really appreciate it. Coming up, natural gas prices, they're well off their highs since the Iran war began, at least here in this country. But the market, especially internationally, is nowhere out of the woods yet. We'll talk about some longer-term consequences to watch from all this when we come right back. The Iran war has caused one of the world's biggest producers, Qatar, to shut down their production of liquefied natural gas. But the U.S. has plenty of domestic supplies. As a result, despite the conflict, the price of natural gas is actually down for 6 weeks out of the past 7 and down 17% so far this year. But the LNG market could still be facing some long-term consequences as a result of the war in Iran. Pippa Stevens has the details. Pippa?
Hey, Kelly, about 20% of global LNG comes from the Persian Gulf, and virtually all of that comes from one facility. That's Ras Laffan over here in Qatar. Now, the Strait of Hormuz is the only exit route for that LNG, and Ras Laffan has actually been offline since March 2nd. Following an Iranian drone attack. Alex Munton from Rapidan Energy telling me Iran's first hit on the facility was a warning shot. If they wanted to do major damage, they could, since Ras Laffan is essentially a sitting deck. What's more, the gas comes from the North Field, that's an offshore gas site, and about 2/3 of that is controlled by Qatar, but the other third is controlled by Iran. And so that means they are intimately familiar with the operation and could do serious damage if they wanted. And while select ships are now passing through the strait, so far no LNG vessels have gone through. This chart from Goldman shows that shipments are now at 0. And nearly 90% of that LNG does go to Asia, where prices are now rising. Unlike most other global commodities, what you pay for nat gas does depend on where you live. JKM in Asia at about $20. In Europe, we're seeing about $17. That means that some cargoes initially heading to Europe are now U-turning and heading to Asia instead because of that price difference. Kelly.
And we'll see, like you said, how long those patterns may last. Pippa, thanks very much, Pippa Stevens. Let's get to Mackenzie Sigalos now for the CNBC News Update. Hi, Mackenzie.
Hey, Kel. A judge has allowed a shareholder suit against Boeing to move forward as a class action. The lawsuit accuses Boeing of hiding safety failings in its 737 MAX planes before crashes in 2018 and 2019. Shareholders of Boeing between November 7th, 2018 and October 18th, 2019 are eligible for the suit. Cuba's electrical system is coming back on after the country's Ministry of Energy and Mines reported an island-wide blackout yesterday. The blackout was first reported around 2 p.m. Eastern. Yesterday, the ministry said on X that no faults were reported when the grid went down. The ministry said today that service has been restored across most of the country. And the Metropolitan Transportation Authority in New York is suing the Trump administration for withholding almost $60 million from a new subway tunnel project. The MTA is claiming breach of contract. Last week, a federal appeals court ruled the administration must keep making payments for the separate $16 billion Hudson River Tunnel project after New York and New Jersey sued. Kelly, sending it back to you.
All right, Mackenzie, thanks. Coming up, Wells Fargo says that $100 oil all year long would wipe out the gains from Trump's One Big Beautiful Bill, at least for the bottom 80% of the population. Our next guest isn't so concerned, though, and we'll talk about why. And as we head to break, take a look at gasoline prices across the country. The national average hitting $3.79 today. We're back after this. Welcome back and take a look at crude oil prices, which have made the Federal Reserve's life a lot more complicated as their two-day meeting kicks off today. Oil has soared more than 50% since the last decision, pushing out the market's rate cut timeline and leaving many wondering how Chair Powell will talk about that rise. Steve Leisman is here with what Wall Street is expecting with the results of the latest CNBC Fed survey. Hi, Steve.
Hey, Kelly. Yeah, 3 weeks into the U.S. attack on Iran, respondents to the CNBC Fed survey forecasting oil to remain high for several months, inflation to increase, and growth to take a modest hit. But the Fed could still be cutting, and maybe cutting twice. $88 is the average price of WTI seen 6 months from now. They're not oil experts, but they have to be now. 0.5%, that would be the boost to CPI from oil prices, and a 0.3% hit to GDP from the rise. Now, 1.8 is still the number of rate cuts expected. That's one full cut and almost all of a second cut. That's different from the Fed funds futures. We only see one cut, and 31% is the likelihood of a U.S. recession in the next 12 months, up 8 points from January, but still relatively subdued, at least for now. Alan Sinai from Decision Economics writes in, big oil price shocks lead to a recession if they last long enough. That is the big risk to the economy, a prolonged Mideast conflict, oil price and inflation shock, uncertainty from this, and then recession. Well, that's not what's quite in the cards yet. The current rate was, or 2025 was 2.1%. You can see they took off a bit from their outlook for GDP this year, but still around trend, and then bouncing back a bit in 2027 when it comes to GDP. Looking at the inflation outlook, we did 2.4 in 2025. And you can see that seen going higher and higher compared to how they forecasted in January as well. So another 0.3 there, or 0.2 there, and another 0.2 on 2027. Bottom line, not coming back to the Fed's 2% target. Big question here, will oil prices bleed into the core? And 38% say it's very likely, 44% saying it's only somewhat likely, and 16% say somewhat unlikely. As for the Fed's funds market, you can see there they're a little bit more optimistic than the market. The average forecast has about 1.5 to 2 rate cuts built in, more dovish than the futures market, likely because many respondents, as Alan Sinai said, focus on the negative effects of oil prices on growth rather than the inflationary effects. So 363 goes to 325, but not much seen in 2027. And about Fed Chair Powell, well, his last two meetings are expected to see no change in the funds rate, likely because inflation remains above target, Kelly, and looks set over the next several months at least to head higher still.
More dovish than the markets. They said I can't talk to you because you have to catch a train, Steve, but that is my big takeaway.
I got time.
Okay.
But that's all right. That's all right.
More dovish than the market.
The train is late, just so you know, as always with Amtrak. But here's the story. The story is that they're focusing on the negative effects, and what you'll need to see are strongly negative or decisively negative jobs reports, and that's going to move the Fed. And as one of the respondents did point out, the market had these cuts built in, took them away quickly. They can put them back pretty quickly.
All right, Steve, really appreciate it. Steve Leisman. I think that train is to Washington, where there's a Fed decision tomorrow. Our next guest says oil will not have a meaningful impact on the economy. And with tax refunds supporting growth, she's expecting 0 rate cuts this year. Nancy Lazar is chief global economist at Piper Sandler. Nancy, I hang on your every word over the weekend and with all of your notes. I love them. I wish we had more time, but here, so let's just cut right to the chase here. So you feel differently, I think, than the consensus in that survey Steve just talked about. You're much more constructive on the economy. Is that right?
I am. In part one, the Fed has already cut rates 175 basis points. The level of interest rates at roughly 360 is well below nominal GDP growth. Think of corporate revenue growth. And so the level of rates is one net stimulative. You see that in banks, their willingness to make loans. Bank loans have indeed picked up, as has money supply. Second, as you've alluded to a couple of different times, there is significant fiscal stimulus, and not just from tax refunds, but also from capital, for capital spending. Net Fed stimulus in and of itself boosts GDP growth this year by 2 points. If you add in the fiscal, roughly another 1.5 percentage points. I don't want to sound too nonchalant when it comes to the increase in the price of oil. And as you've emphasized, if it stays at $100 for a sustained period of time, then we might have to clip our forecast in the back half of the year from currently we're using 3, maybe something a little closer to 2. But this is not the same economy that we've had over previous oil shocks. That is, in the 1990 period, we were still a net energy importer, net oil importer. It really is over the past 15 years that we've become a net energy exporter. As your table highlighted, natural gas prices here in the United States are low because we produce obviously plenty of natural gas here, and we are indeed an exporter. The low-end consumer will get hit from these higher energy prices, to be sure. But again, I'm not comfortable saying this. They're just not the driver of growth. It is that middle-income consumer who will see a benefit from these tax refunds. The labor market has incrementally improved. Tell me why unemployment claims have come down. If the labor market is deteriorating, why so many anecdotes of employment from the ISM surveys to regional Fed surveys show that the employment backdrop is incrementally improving. And so there are a lot of green shoots as we moved into 2026, reflecting what I've just talked about. And it depends upon how long oil prices stay high before we can really get a good handle on how soft the economy might get as you move into the back half of the year. But net right now, we've got a pretty strong backbone.
Yeah, you've been really emphasizing this CapEx boom. I mean, look at the ISM surveys. A lot of people in the market are talking about this as well. The areas of the market that are doing well, those cyclical names and so forth. But I think the labor market point you're making is really important, because if I'm on the Fed, if I'm Warsh, if I'm whomever, and I'm making the point that we need lower rates, there's probably two reasons. One is the labor market. We want more hiring. The second would be kind of the Barry Knapp argument that, they use the balance sheet to ease, but then they hiked with the rate, and that has resulted in a K-shaped economy. Does that rate need to come down so that there's, better borrowing costs for smaller businesses? And look, those are the ones that do a lot of the hiring.
So small business confidence did come down in the latest survey in February, and it didn't reflect obviously the Iran turmoil yet anyway, but their profit backdrop did improve quite significantly in February. And so that actually is what leads employment. So even for small businesses, again, I think there's way too much looking in the rearview mirror and not looking at the lagged effects of all the stimulus that's already been put into the economy. And quite frankly, if you cut rates too sharply, all you do is make housing unaffordable again, as the Fed has done over the past 15, 20 years by sharply lowering interest rates, causing short-term housing booms and then short-term economic booms. And then again, what you end up with are higher prices, particularly on the housing side, and you really squeeze people out of the home market. So the Fed has already cut rates. Rates are historically low. You were getting green shoots for the economy, signs that economic activity was broadly improving, from capital spending to the labor market, even housing. The NAHB index yesterday obviously coming in a little bit on the brighter side. Nothing is booming, but a gradual improvement in growth makes it more sustainable, because you don't then get these price price shocks.
I want you on the Fed. I want Warsh is in the chair seat, and you're going to be over there, Nancy. And I want you how you guys can come to a mind on this. We'll see. But he's got some time, I think, before we have to worry about that. Nancy, we'll leave it there for now. Thanks so much.
Thank you.
Nancy Lazar with Piper Sandler. Coming up, the AI giants like Anthropic and OpenAI are promising their applications increase productivity. But what happens when these companies themselves are struggling with efficiency? We'll take an inside look at how they're trying to streamline business ahead of an IPO when we come back. We're getting new details today from an OpenAI all-hands meeting where leadership doubled down on the push toward their enterprise business and an IPO. What does it mean? Kate Rooney has more in today's Tech Check. Kate?
Hi, Kelly. So that was the message from Fiji Simo. She is OpenAI's CEO of applications. I spoke to somebody who was in the room at her employee all-hands last week. The source says that she really emphasized why their enterprise business is so important. This was to employees. She really tried to rally employees around that message. According to this person, Simo said that the opportunity is to now take ChatGPT's 900 million users, turn them into high compute users, and transform ChatGPT into a productivity tool. As part of that, OpenAI has been shifting its focus from some of the less profitable projects within the business. The Journal was first to report some of these details. Someone close to Sam Altman also tells me it does fit within his broader strategy for OpenAI. Enterprise and ChatGPT have had the most material impact on revenue ahead of an IPO, and OpenAI is going to need to prove more discipline, not just talk about it. And that is where CFO Sarah Friar is coming in. I'm told by sources she's been getting OpenAI ready to list as early as the fourth quarter of this year, discussing which GAAP metrics to use. We have reported she has been putting out a more defined infrastructure spend, $600 billion versus more than $1 trillion to investors. And then Friar also, I'm told, is beefing up the IR team. She hired Cynthia Gaylor, that's Morgan Stanley's former banker. She was the CFO of Dropbox, to really help get that message out to Wall Street, Kelly.
All right, Kate, for now, thanks. Just want them to go public. Kate Rooney. Coming up, U.S. markets are under pressure this month. The S&P lower by about 2%, while the Dow's down about 4%. But international investors, boy, are they having a tougher time. Europe faring a little better than Asia. The Euro stock's down 4%, while the Kospi is down 10%. But do those dips represent buying opportunities? That's next on The Exchange.